multidisciplinary paper, and within the limited time, how do you handle financial statements, the consolidation accounting standard, and also it brings together other disciplines like corporate governance, ethics, as well as risk of misstatement from auditing perspective. So it is a very challenging paper, and I'm sure Chamath will do a great job today in terms of giving you the insight, because I'm most often my assessment of this exam results in the past, some of you tend to believe that this is a typical financial reporting paper, which is not the case. Like I already said, you have to be very strategic in approaching this paper. So if you simply look at the syllabus, we don't need to do any PowerPoint presentation today. You would have seen enough such presentation and you have gone through the syllabus. But at a glance, if you summarize this paper, this has about 55% content focusing on consolidation and accounting standard, as well as about 45% content covering the auditing aspect, corporate governance, and ethics. So one of the very reasons for students to come down this paper is they are overly focused in one area without giving that holistic picture. And even in this discussion, you will realize that if you have a very good knowledge about accounting standards, right, even in this pilot paper, if you look at, there are a few questions which Chamath will discuss with you about accounting standard like revenue recognition. Also, I should highlight, while appreciating the effort of the Institute with the limited time, I know that this paper is not backed by pre-seen, right? Ideally, if you look at the past exam paper, the pre-seen you have to analyze as a holistic paper, and already pre-seen has been released. When I say that, there is a 50 marks question, and that question can combine financial reporting as well as auditing aspects, right? So therefore, in summary, what I am saying is, when you prepare for this paper, be very strategic, because easily you can score, even in the area that I am going to cover with you. I'm sure usually, those students who are doing this paper might say consolidation is really a challenge. Of course, you have to practice, but if you only do that, there is a greater chance you will not score above 50. So that's why I said you need to be strategic in approaching this paper. And accounting standard coverage, if I'm not mistaken, in the syllabus weightage, is about 30%. If you are very thorough with that 30%, and if you know the language of auditing, right, you can get another 20%. So 30 to 25%, that is risk of misstatement. So what is the risk of misstatement? So risk of misstatement is the difference between how company has accounted for and the correct way of accounting based on SLFRSs, right? Say company has accounted, a company has not impaired or inadequately impaired. So then you will apply accounting standards to explain that in risk language. So that is a 25% of the paper, predominantly on identifying risk of misstatement. So my main advice before we start this discussion is to look at the paper holistically and then approach it. So passing this paper is not definitely a challenge. Not a challenge if you are prepared. So I think Chamath will start the session, while he can also give introductory remarks. And I recommend Chamath to start the paper with accounting standards, and then probably I can take other questions, and then I allow the most favorite topic to be consolidation, and Chamath to spend a little more time by explaining that area. So Chamath, over to you.
Thank you very much, sir. Actually, Suranga sir has given the basic understanding about the paper. So as you all know, and as I know, and as we all know, this is some kind of an not an easy task when it's come to strategic level paper. And we have seen a lot of students, even though you are starting and you are studying, and actually I was also, when I was a student, I was also challenged in the institute. But recently, since I am closely working with the institute and especially with the education division, and actually for this time, for this paper, I have received some of your answer scripts. I have received some of your answer scripts, and I was quite surprised. And I have seen some of the students are not actually, let's say, 75% of the students are not up to the expected level, and they even don't know the basic theories behind the accounting standard. So this paper is not that kind of a tough paper. It is some kind of a moderate paper. So, but student still find some, they are struggling in terms of, let's say, SLFRS 15. I know now you know accounting standards because you have gone through a lot of theory class videos and study packs, revision kit, and there's a separate webinar series provided by the CA Sri Lanka. So all those things, resources are there, and most of you are working. Maybe most of you are in audit firm, others are in mercantile firm. So you know the accounting standard, but still very basic question. There are a lot of deficiencies when you are going to answer. So that's why I thought of starting the session without even limiting to this discussion only for the answers to give the mock paper. I thought of doing some kind of an additional support as well, because this entire objective of this mock paper is not to give you some questions and give you some answers. The entire purpose behind this mock examination is to somehow they want you to get through this examination, and since you all believe this is as a hurdle, so they also want you to get through this examination, and they want to give you the message where you are going wrong. So let's start with some major, or I would say the continuing comments coming from the examiner. So it's very important, student. So when we say the examiner, I have noted some points the examiner is telling in his comments. The first one is this is an open book examination, you know that. So whatever the permitted publications are allowed to take to the examination. But the point is, my student, most of you are not using the permitted publication in an effective way. So you are actually having ineffective usage of permitted publication. Most of the time, what the students are doing, when it's come to the examination, when there is a question, they start reading the standard book, or they are starting reading the accounting standard. It will not work, because if you are carrying a permitted publication to the examination, you should have some pre-preparations as well. You should have done some homework as well. You have to read the accounting standard. You have to highlight the accounting standard. You have to underline the accounting standard. And other mistake most of the students are doing is they write some of the theory class questions in the standard book. They write some small computations in the standard book, but don't do it, student, because ultimately we are going after a profession which is highly ethical, and we have to protect the public interest as well. In that kind of a situation, if you are starting doing some kind of a not allowed things in this particular standard book, it will not accepted at any cost. So be mindful on those things as well. And student, other thing is, most of the time when we are having some discussions with some students who got failed 2 to 3 times, some of 4 to 5 times, and the biggest complaint that I am getting is actually the time management. Most of the students are saying the time is not enough. Sir, we know the accounting standard, but the time is not adequate. Why the time is not adequate? Just because of 2 reasons. I have identified a student just because of 2 reasons. The first one is you are not reading the action verbs. If I ask you a question like this, where these action verbs are in, you might not aware. It is in the study pack. If I'm not mistaken, immediately before to the content slide, the action verbs are there. Because every question is having action verb. There are some questions which is saying outline. There are some questions which is saying describe. There are some questions which is saying critically analyze. Likewise, there are a lot of action verbs given in. If you haven't identified the action verb, you will end up with this kind of a lower pass rate. Why I'm telling you that? Sometimes the paper is specifically mentioning outline, and some of you or list down, and some of you are writing a lot of paragraphs in that kind of a question. Sometimes the paper is say critically analyze, you will end up with some listing down some points. So that should not be done. So you have to focus on the action verbs. Another thing is marks allocated. So when I am going through one of you transcript for this mock examination paper, there's a revenue related question. Actually, the question carries 6 marks, and I have noted 2 students have wrote answer 1.5 pages. Why? no point. And some of you have started from irrelevant things as well, no point. So you have to be mindful about the marks allocated as well. If the 5 marks are allocated, you have to write whatever the things which is enough to get 5 marks a student. If you know the accounting standard, it's a different story, but don't try to put everything that you know to the paper. Focus on the action verb as well as the marks allocated. That is the key behind success. Another thing is, most of the time I have seen, as Suranga sir mentioned, you are not understanding the weightage of the syllabus, because accounting is standard. If you are focusing too much on accounting is standard, if you are focusing too much on consolidation, you may be ended up with maximum 50 marks. If you are writing whatever in a perfect way, you will be ended up with only 50 marks. You actually not 50 marks even, it is not possible. If you take 50 marks, you can get passed. You will end up with not more than 40 marks, let's say, right? So that's why I'm every time telling to you students, you have to focus about the other parts as well. So Suranga sir will take you through those things as well. But anyway, so other thing is, when it's come to the question, what you need to do is, before answering the question, you need to read and understand and plan. 3 things you need to do. You have to read the question fully, understand the scenario, and you have to plan by preparing some kind of a sketch before approaching the question, before approaching the answer. You have to have some kind of a sketch, and then only you have to proceed with the answer. So most of the students are not doing that. What is happening most of the time, when you are reading first 2 to 3 lines of the question, some questions which is similar to this, it's coming to your mind. Maybe you have done it in your study pack, maybe it was in your revision kit, maybe in a past paper or any other ACC or ICAW past paper. Those things are coming to your mind, and you are thinking, this question is the same question which was there in that particular past paper, whatever the source. So what you do is, without reading the remaining part, you will start writing the answers with having some kind of a pre-conclusion regarding the question. Then ultimately you will end up with a completely irrelevant answer. So until the last word you have to read, because one word is very much important. Especially I know in this particular model paper, so I will tell you, there are some one word answer is completely getting upside down. So that you have to be mindful, students. So read the question very carefully. And other thing is, don't write irrelevant theories. There's a SLFRS 15 question. In that question, I have noted a lot of students start writing by describing the 5-step model, which is not actually required. So when they fair value measurement, you will start with defining fair value, not required. When they say revenue recognition, 5-step model. When they say SLFRS 9, you start with defining financial instrument, which is not actually required in the question. So examiner is specifically mentioning student reproducing the standard as well as reproducing the questions will not bring you anything. So you have to be mindful that. So don't write and go and cut and look at the standard book, cut and paste. Don't go there. Copy and paste. Don't go there. Right? You have to be mindful that. So you have to build up the answer. You have to write the theories which is only relevant to construct your argument. Other than that, don't stuck into a lot of theories. And one more thing, even Lakmini also wanted me to give this message to you. Still, even though you are at the strategic level, you are following poor examination techniques, student. Some of the students are not starting the new question with a new page that is there. And other thing is, some are not even putting the question numbers. Don't do it, because the one who is looking at your paper will not look at what you have done, and they will not look at what are the question numbers. Okay, so what you have to do is, you have to be mindful. Simple examination techniques also you need to follow. So there are a lot of things that we can discuss with regard to the examination mistake, but I think these are more than enough. These are the most common mistakes that we see as well as the examiners see. Right, students? So we will go to the paper. So I will share the screen with you. Can everyone see the screen? Can someone please reply whether you can see the screen that I have shared?
Yeah.
Okay,
Yeah,
thank you.
We can
yes,
see.
Thank you. Yes. Okay. Anyway, student, I will go to the question number 1. So we will start with the question number 1. So normally when it comes to the accounting standard student, most of the time, there are some critical standards which are regularly testing in the examination. Let's say SLFRS 9, SLFRS 15, and SLFRS 16 leases. Those standards are more or less oftenly tested in the examination. But I am not telling you have to do selective learning. But I have seen what I have seen in last few past papers. The examiner is testing from the other standard as well. Even sometimes some other impairment, LKS 36, LKS 36, likewise, those standards also they are going to test. So I would say you have to focus on the entire things, but based on the past paper and all those things, you can judge what are the things that you need to pay more attention when it comes to the examination, because we have an only remaining another less than 20 days time, right? So here, student, so we are starting with the Fortune XPLC, and before starting the paper, actually, I would like to thank the Education Division to taking, actually, this is the first time that they are doing this kind of an physical examination as a mock examination to you. And it's a really, there is a great effort came from their side. And I think they have done a considerable job and within a limited time. And we have to say kudos to them. And right. So question number 1, Fortune XPLC is a listed company in the Colombo Stock Exchange, which has many business interests around the Southeast and Middle East. Following transactions, events have occurred during the year ended 31st March 2021. Draft, this is the action verb student, draft an explanatory note to the board of directors of Fortune XPLC as per the requirement specified under each scenario. Right. So we will go to the first one, student. 31st March 2020, Fortune XPLC acquired the controlling stake of Siang Limited, a company which has head office in Singapore. Right. Siang Limited is managing its own plantation in Indonesia. So what is happening? There's a company, the head office in Singapore, and the plant, whatever the plantation is in Indonesia. Employees of Siang Limited who are based in head office are paid in Singaporean dollars. So what is happening? Some of the employees paid in Singapore dollars, right? While most of the employees who work in plantation are paid in Indonesian rupiah, which contributes more than 80%. So let's say out of the employees, 85% paid in Indonesian rupiah, IDR. This is the code we are using, IDR, right? So, and all the revenue of Siang Limited is generated in Indonesian rupiah. So the revenue generation, 100% of the revenue generation in terms of the currency Indonesian rupiah, IDR, while most of the costs are paid in Indonesian rupiah, costs also paid in terms of IDR. Siang Limited is generating significant amount of cash to Fortune X Group, and hence Siang Limited is very much independent. So this Siang Limited, the subsidiary, Fortune is the parent, Siang Limited is the subsidiary. Siang Limited is very much independent. They have a significant degree of autonomy when it comes to their business operations from Fortune XPLC and does not rely on parent company for financing needs. So they normally, what is happening, if there's a subsidiary, they always looking for the parent when there's a finance need. But Siang Limited is having more independence in terms of their financing and business operation. Right. Since the profit are transferred to the head office, what is happening at the end of the specific period, the profit are transferred into the head office. In Singapore, the retaining in Singapore dollars. What is happening? The profit are transferring to the parent and parent retaining the profit in terms of Singaporean dollars. The company is liable to pay taxes in Singaporean dollars. So company is liable to pay tax in Singapore based on SGD. Advise the board on determining functional currency of Siang Limited. So what is ultimately required from us? Functional currency. So a student, can you all see some kind of a standard reference? Can you all see the standard reference that I have shared? Right. Okay. So here, very important, the action verb, very important. So that's why I have separately discussing this as well. Go to the study pack. So you are not reading the study pack normally, but there is a very good study pack. We have a student, good examples, which is developed by BPP Learning Solutions. Actually, BPP Learning Solution is developing the materials for ACC and other professional examinations in globally. Those are validated materials. So very good examples are there. So you have to refer the study pack. There's no rocket science. So here, student, action verb also there. You have to go and see draft. So draft is in a tier 6. Right, but you are required to solve unfamiliar problems by combining different aspects to form unique or novel solutions. So you have to give solutions, right? And draft, the keyword is draft, the action word is draft. Write original materials for scrutiny of others. What is mean scrutiny? Critical observation. You have to do critical observation, not just observation. You have to go and critical observation, and you have to provide the answer. So that is what required in the action verb. Okay, student. Before moving to the particular, I would say the question, just wanted to remind the LKS 21 to you. I think it will be more important. Within 2 to 3 minutes, I can remind you about LKS 21. So student, basically, the LKS 21 is all about effect of changes in foreign exchange rate. So basically, I can divide the standard into 2 parts. The first one is individual transactions. So standard basically talks about foreign exchange impacts for individual transaction. Let's say you are buying a property, plant and equipment, and you pay on a later date. The property, plant and equipment supplier is not from Sri Lanka. He is from some kind of a US or any other country. In that kind of a situation, you may have to end up with some kind of a exchange gain or loss just because of your individual type of a transaction with that you have encountered. Another thing is business operations, or we can say foreign operations, right? Foreign subsidiaries. So student, this is mainly discussing under consolidation. So far in the institute, this particular paper, they have not tested a foreign subsidiary, right? Recent past, they have not tested a foreign subsidiary. But if you see the EOSL case study, we have Equip Office Solutions Limited, this time case study, this time pre-scene you have, they have discussed about some foreign players are coming into invest, some foreign transactions are going on. So this LKS 21, I believe, when analyzing the pre-scene also, this time it is highly testable area. So this consolidation foreign subsidiary, you have to be mindful on going through that part as well, but I am not going to discuss that thing in detail. When it's come to the good consolidation of foreign subsidiary, you have to be mindful about 2 things. Goodwill retranslation as well as net asset retranslation. If you can't remember those things, go and look at the study pack and any other sources which you have at the moment, right? When it's come to individual transaction, student, there are 2 types of gains for me. Actually, this definition or this division is not actually given in standard as it is, but I will say normally when it's come to individual transactions, we have transactional gains and translational gains. Right, transactional and translational. What is mean by transactional gains? Basically, I have communicated you earlier. Let's say 1st January, you are purchasing a property, plant and equipment from a US supplier, and 2nd February, you are paying to that US supplier. There's a time lag, 1st January to 2nd February. Just because of that, definitely you have to encounter some kind of a foreign exchange rate difference, and there might be a gain or a loss arising from that. That kind of a things we call transactional gains. And what is most worrying is the translational gain. Let's think that particular supply is not paid as of the reporting date, 31st March. Then what is happening? As of the reporting date, this asset should be translated to the whatever the spot rate prevailing at the reporting date, So that is what we call translational. So when it's one to the translational, students, actually the standard is stating 2 things. We have monetary assets and non-monetary assets, right? We have monetary assets as well as non-monetary assets. When it's come to non-monetary assets, monetary asset means where there is a cash flow going out or coming in. That's what we call monetary asset. For example, trade payables, trade receivables, bank loans. So settling or receiving, you are having a cash flow involvement. So those things are we call monetary asset. When it is come to the balance sheet date or the reporting date, what you are required to do it, you are required to only translate this monetary asset to spot rate, or what we say the closing rate at the reporting date, or closing spot rate at the reporting date. That is only the monetary, it is required only for the monetary assets. When it's come to non-monetary assets, student, we are keeping at historical spot rate. Let's say it's a PPE, that PPE is shown in the financial statement at the historical spot rate. But what is happening normally, if there is a requirement for fair valuation or a revaluation in that kind of a situation, even non-monetary assets also using some kind of adjustment with exchange rate, but it is not considered as exchange rate gains or loss. It is treated under fair value gain or loss or revaluation gain or loss. So that is the basic understanding that I can give you. This particular question is not all about this, student. This particular question is all about determination of the functional currency, determination of the functional currency. So there are two definitions, presentation currency as well as functional currency. Presentation currency means, student, what you are preparing the financial statement. That is what we call a presentation currency. Functional currency means the currency. If I'm not going to the definition of a standard, a simple definition, I would say the currency which you do your business, currency which you do your business. Normally, if it is a local company, the functional currency is rupee, Sri Lankan rupees. It doesn't matter what is happening. If you are doing your business in multiple currencies, let's say USD, Euro, multiple currencies, you have to determine what is your functional currency. What is your functional currency? It's very critical. It is like this, student. If you have, let's say, 2 to 3 currencies that you are using at the moment, what you have to do is you have to weigh based on your revenue, based on your cost of sales, based on your labor cost, some other factors, considering a lot of factors. You have to weight each of these currencies. Let's say you are weighting USD and rupee, likewise you are weighting, and whatever the currency which having more weight, you are going to consider as the functional currency. It's like a balance. It's like a scale, student. So this side LKR, this side USD. So whatever the side goes down, whatever the side is having more weightage, you are going to recognize as the functional currency. So with that understanding, student, we will go to the question again. So here, right. Sorry, I have to, right. So basically I have extracted the theory parts also for you from the accounting standard, and I have mentioned the reference as well, but in the examination you are not required to write the reference and all those things. If you can remember the definition and all those things, you can straight away write those. And here you can see, so I have given the standard references. Functional currency is the currency which primary economic environment which entity operates. Basically, it is the primary economic environment. What is the what kind of economy? Let's say you are in Sri Lanka. Sri Lankan currency is becoming the functional currency most of the time, but we can't limit into that particular situation. We will do to that particular situation. So other thing, we have to go after a lot of factors to decide what is the functional currencies. So here, as per LKS 21 student, they are giving some primary factors to decide functional currency, some secondary factors. If these primary factors are not conclusive, you can go to the secondary factors to decide functional currency. So I will read very quickly these things. The first one is sales price of the goods and services. What is the currency you are using for revenue generation? It is the functional currency. And the next one, what is the currency you are using for labor, material, and other cost of providing goods and services? It is becoming the functional currency. And if these two factors are inconclusive, you can go to the secondary factors. The currency in which funds are generated by issuing debt and equity. It means what is the currency that you are generating funds required to the company? What is the currency you are taking bank loans? So that can be the functional currency. Or last, they are saying currency which receipts of operating activities are returned. Basically, what is this? Basically, how you retain your profit. In which currency you are retaining your profit. That is becoming the functional currency. So other than that, if it is a parent and subsidiary relationship, what is happening most of the time? Parent currency becomes the subsidiary functional currency. Parent functional currency becoming the subsidiary functional currency, but it is not required always. The standard says subsidiary can use a different functional currency than the parent, they can use the different functional currency than the parent if these conditions are there, if these features are there, if these factors are there. So what are these? Foreign operations are carried out with a significant degree of autonomy. Subsidiary is independent. They have the significant degree of autonomy. They are a lot of not depending upon the parent. In that kind of a situation, subsidiary can use their own functional currency other than the parent. Transaction with parent are low proportion. So there are very limited transactions with the parent. So let's say you have revenue, not majority revenue you are generating through parent, you are generating revenue for some outside third parties. Let's say you have low proportion of transaction with parent. Cash flows from foreign operations are readily available for remittance to the parent. So the cash flows, so subsidiary can remit whatever the profit earned to the parent. In that case, also you can go ahead with the subsidiary functional currency. Foreign operations has sufficient cash flows to survive debts without needing funds from the parent. That also basically mentioning about the autonomy. Subsidiary has the independence, the autonomy, that they don't need the funds from the parent. They can survive by themselves. So I am not going to discuss these things in detail. I can let a lot of time and I can discuss, but I will quickly jump into the question with this understanding. So student, let's come here. What is happening? So now we will read it again. On 31st March, Fortune X plc acquired controlling stake of Sian Limited, a company which has head office in Singapore, right? Sian Limited is managing its own plantation in Indonesia. Employees are Sian Limited, employees of Sian Limited. So what we have to determine the functional currency of the Sian Limited, obviously. So Fortune Limited, the functional currency is dollars, right? In this case, but we have to decide the functional currency of Sian Limited. So what is happening? 85% of the employees are paid in terms of Indonesian rupees. So which is having the more weightage? Labor cost, Indonesian rupees. So Indonesian rupees is the functional currency. So this is backed by some other things as well. So 100% of the revenue generation is also based on Indonesian rupee. So what is happening? IDR, revenue generation also from Indonesian rupee. And what is happening? Go forward. All the cost also incurred based on the functional currency of Indonesia. So that also evident that what is happening? The functional currency is Indonesian rupiah. Other than that, here mentioning there's a much independency. There's a significant degree of autonomy that subsidiary is having. In that case, if they are having some kind of autonomy with the Fortune X Limited, that also telling that particular Fortune Limited functional currency should not be the functional currency of the subsidiary as well. So that also backing the point that Indonesian rupiah is the functional currency. So other than that, there are some points which says, so they are remitting whatever the profits to the parent, and what is happening? Parent retain whatever the profits and whatever the profits in terms of Singapore dollars. This is a plus point for telling the functional currency is SGD, but we have to consider the wastage, students. If you think about the entire perspective of this question, 4 to 5 points are there to tell you the functional currency is Indonesian rupee, and only 1 point to tell the functional currency is Singapore dollar. So what you have to conclude, basically the functional currency is IDR, not SGD, right? So we will move into the next question. So student, when we are moving to the next question, is all about the favorite area we all have, SLFRS 15, right? Fortune X plc has controlling stakes in Vera Technologies Limited, a software development company. So normally, student, when SLFRS 15 comes, I can remember in 2018, there's a huge discussion, especially in software development companies, because there are a lot of arrangements providing the hardwares, providing the software, annual maintenance, upgradations. Likewise, there is a lot of discussion going on with software development companies. So anyway, this question also from software development companies. 1st June 2020 onwards, VTL develops and sells enterprise resource planning system, ERP systems to customers based on 5-year license contract. So 5-year license is there to ERP. There's a ERP based on a 5-year license contract. During the 5-year period of the contract, VTL provide annual update, right? So what they have the ERP system plus the annual update. to ERP end of the each year, without which ERP could not function. What is happening? Without this annual update, student, ERP cannot function. Let's say you are not going to have the annual update this year end, you can't use the ERP system. So update is required. It is highly interrelated with the license provided by the company. VTL charge USD 5 million for total contract. So this is the total transaction price, 5 million for the total contract, including annual updates. So both of these, license and the annual update, they will charge 5 million. Meanwhile, VTL sell standalone package of this ERP license, where annual update to be purchased separately, 530,000 per annum. So what is happening? Meanwhile, so anyway, this is there, but on the other side, the same company sell this license separately, plus what is happening, whatever the upgrade you can purchase separately. Update also you can purchase separately. The effective interest rate of VTL is 10%. Advise the board on revenue recognition of VTL in terms of SLFR 15. So students, so far I have discussed a lot. So I am giving you the chance to give me the answer. Simply I am asking, how many performance obligations we have? How many performance obligations? Let's say I will make it easy. One or two. How many performance obligations we have? 1, 2. So they are Nekmal is saying 1, Chamod is saying 2, 1. It's a confusion. So you can see it's right. There's a confusion. Another 20 days to the examination. You know the SLFR 15 very well. That I can show. You know the SLFR 15 very well, but still we have some confusion, right? So we'll go to the theory. We'll go to the theory and we'll go to the standard and see what it's actually mentioning. Right, student. Here, so just to give some kind of a brief understanding about the SLFRS 15. So when we say SLFRS 15, it's what is happening, student. SLFRS 15 is all about recognition of revenue from customers. Revenue from customers, not revenue from some other sources. Revenue from customers. So here, basically, it talks about contract with customers, revenue from contract with customers, not contract with employees, not contract with fund providers. That is captured under SLFRS 9. Basically, contract with customer, regular revenue it's talking about, right? When it comes to SLFRS 15, student, when I say SLFRS 15, what comes to our mind? What comes to our mind? For me, the 5-step model comes to my mind. When I say SLFRS 15, the 5-step model comes to my mind. So just to remind the 5-step very quickly, the first one is identify the contract. Then the next one is what? Identification of the performance obligation. Identify the performance obligation. Then determine the transaction price. Third step. And fourth one, allocation of transaction price. And the final step, revenue recognition. So that's how the five steps are there in the 5-step model. Whatever the revenue, not like the previous standard, whatever LKS 80, whatever the revenue from construction contract, sale of good, provision of services, whatever the revenue recognition should be success to this 5-step model. So I'm asking another question also from you, student, since I have to engage you also to this discussion process. What is most important in 5 steps? What is most important? What is the most important point in these 5 steps? But you can say. So I need the answer. So Nekmal is saying performance obligation. Himal is saying contract. Madhushanga is identification of contract. Yes, Chamod, Madhushanga, right. Absolutely good. Very well done. The most important thing is, student, not the performance obligation. Identification of the contract. Contract identification is vital in this process. Why? The contract is everything. Why? Just because of 2 reasons. The first reason is you have to identify the contract. Why? There are some contracts which cannot be sent through the 5-step model. Let's say there is a contract. There is no there's no reliability of receiving the revenue. If the revenue receivability is not reliable, then can you send it through the 5-step model? No, student. You have to wait until the revenue received in cash to recognize the revenue. So you can't send it to the 5-step model. So you have to wait. So basically, identification, the scope, what kind of a revenue that I can send through this 5-step model, identification of contract is very much important. Another thing is to going after or to successful completion of the subsequent process, determination of performance obligation, determination of the transactions price, where you can determine. If you have read and understand the contract only, you can determine the performance obligation. Otherwise, you can't determine the performance obligation. Otherwise, you can't determine the transaction price. In the contract, it is there. What is the rights and obligation of the supplier? What is the right and obligation of the customer? All the things are mentioned. Through that only you can identify the performance obligations and you can determine the transaction price by the payment terms which is included in the contract. That is why contract is very much important. Contract is very much important. Two things: scope, to determine the scope, and the subsequent state performance obligations and transaction price. So what is meant by performance obligation, student? Performance obligation is a promise. It's a promise embedded in the contract. It's a distinct promise. Distinct promise. That is the word distinct. Very important. Distinct. Separately identifiable promise in the contract. So that is what we call performance obligation. So it's come to the determination of transaction price. Determination of transaction price, the third step. So second step, you have to identify what are the different promises that suppliers agree. So when it's come to the determination of transaction price, what is important? So if it is a normal transaction, you might ask, yes, I pay cash and only cash consideration is there. But there are some other things as well. Not only the cash consideration is student, there may be some variable considerations, non-cash considerations, there may be some refunds, there may be some consideration you have to pay to the customer. Normally, customer is paying to you, but there might be some considerations that you have to pay to the customers. So those things are there. And significant financing components, significant finance, installment payment, and deferred payment. Lot of things can be there in the determination of transaction price. If you are lucky, if you are getting the cash consideration, but otherwise you have to focus on the determination of transaction price. Then allocation of transaction price. So soon after you have determined the transaction price, that determined transaction price need to be allocated in between the performance obligations identified in the step 2. So you have to allocate the transaction price in between or among the performance obligations that you have already identified. So what is happening, student? How to allocate? How to allocate? The standard is saying standalone selling price. Standalone selling price. Standalone selling price. Let's say there's a AC and installation services. So there's a company providing AC machine as well as installation services. So how you determine? If they are providing the AC machine, what is the price that they are charging? If they are providing the installation services, what is they are charging? So maybe in between these two, based on the standalone price, maybe use some pro rata basis or any other mechanism, you are allocating the transaction price. Let's say there is a company who is not providing the installation services on a standalone basis. Then what you have to do? If there is a separate promise given in the contract, but that promise, performance obligation or separate good or service is not providing on a standalone basis, what you need to do? You have to estimate the standalone selling price. You have to estimate the standalone selling price. That is more crucial. Maybe present value of future cash flows, residual value approach. Yeah, there are a lot of approach that you can determine the standalone price. So there is a estimation as well. It is not required to be that company is selling that particular good at the moment to say it's a standalone selling price. You can estimate and get the standalone selling price, student, right? So revenue recognition is the final step. After you do all these 4 steps, you have to recognize the revenue at which point? Upon satisfaction of performance obligation. Upon satisfaction of performance obligation, you have to recognize the revenue at that point. So what is happening is during the performance obligation also, you have 2 types of performance obligation. The first one, performance obligation satisfied over time, and there are some performance obligations satisfied at a point in time, at a point of time. So when it's come to performance obligation satisfied over time, what you have to do, using some progress or the percentage of completion, you have to find the revenue that you should recognize. So that is the initial understanding, student. We will go to the theory, the remaining theory, which is required for this question, So student, at the contract inception, entity shall assess the goods and services promised in a contract with customer and shall identify performance obligation. Obviously, we know. Good or services that promise to a contract is distinct if both the following criteria are met. So what is telling a student to say distinct, two criteria need to be satisfied. Two criteria need to be satisfied. Very, very important. Listen very carefully. The first one, customer can get the benefit from goods and services either on its own or together with any other resources which is readily available. So tell me, student, in this particular context, you have a license. Can you take the benefit of it? Yes, of course, you can take the benefit of this. And you have the upgrade services as well. So you can take the benefit of ERP license by its own. So you have the ERP license by its own. Individually, you can take the benefits. Upgrade. What you can tell about the upgrade? From the upgrade also, you can take the benefit, but not individual basis. What you can do together with whatever the resources readily available, together with the ERP license that you are available at the moment. So what is happening? This license and upgrade services satisfying the first criteria. And there's another thing, student, the standard is telling. If normally the supplier is selling these goods and services separately, we can say it is distinct in terms of the first criteria. So even the supplier is not required to sell separately. Let's say similar suppliers, competitors are providing this kind of services separately, we can say it is distinct. Let's say this upgrade services is provided by a similar supplier, competitor, then you can say it is distinct. But it is not enough. You have to go with the next one as well, student. You have to go with next one. So what is happening? Entity promised to transfer goods and services customer is separately identifiable from the context of the contract. Very important, student. The next one is the customer agreed to provide it as a separate good? Let's say construction of a hospital, building construction is there, and some hospital beds and other equipment is there. So what you can say, by look at it, the building construction is a separate promise, and for beds and other equipment is a separate promise. But let's say the contract is telling you specifically in the contract, I am responsible for overall management and I will provide the overall management including all those services. If the supplier is selling that, telling that even though the goods and services are distinctly, separately identifiable, since the supplier is agreeing to give you a combined output, it is not distinct, student. It is not distinct, right? So for this fact, the standard is giving some other 3 sub-points. Paragraph 29, they are giving some 3 sub-points. What they are saying, supplier might provide factors indicate promise transfer goods and services separately identifiable. Suppliers might provide significant services of integrating goods and services into a bundle that present combined output. The hospital example, this is an illustrative example actually, student. If goods or services do not significantly modify other goods or services promised in the contract. Goods and services are highly dependent on, highly interrelated with other goods and services. So what you can say, student? So in this particular contract, anyway, they are agree. Actually, this first point is not that much. It is silent in the question. But this point, what you can say, they are providing highly interrelated, highly dependent goods. Can you use the license without having to upgrade? No, you can't use. There's no point of upgrade individually and no point of license individually. You need to have these both interrelated products, interrelated outcomes. So what is happening? If these things are interrelated, you can't say it's separately identifiable. It's a combined, interrelated. And other thing is, what is happening? The second point, if you don't have the upgrade services, the usage of the ERP system, you can't use actually the substantially, significantly modified. In that case also, you can't say it is distinct, student. It is distinct, student. So what you can say, student? Shall we go to the question? And I am asking the question again. Do we have, or how many performance obligations we have? Now tell me, student, even though standalone price is mentioned, this particular example, there's nothing mentioned that these upgrade services can be taken from some other suppliers. Have they mentioned something like that? Can we take this service from some other supplier? No, it is not mentioned. Another thing is these two, license and the upgrade, is interrelated product, highly dependent. The system can't process without the license. So what you can say, student, what you can say? One. Yes, Chamo, absolutely right. Now we have one performance obligation. So see how it is difficult. Even though this very much seems like a easy question, it is not easy, student. So you might think, some of the students have mentioned me after the mock paper, it was easy. There was a revenue question, it was easy, but I know most of you have not provided the answer, So, right. So that is the answer, student. So we will go to the next one. So it is from SLFRS 9. Again, one of the favorite area we have, SLFRS 9. So student, when it comes to SLFRS 9, I will give you some kind of a brief introduction about the SLFRS 9 first. So student, when it comes to SLFRS 9, implemented in 1st January 2018, with early adoption is permitted. So basically SLFRS 9, you have to focus on three main areas. The first one is financial assets and liabilities. The second area is expected credit losses. Sometimes we say impairment, but the correct word is expected credit losses. And the other area is derivative and hedge accounting. So when it comes to the examination paper, student, this financial assets and liabilities is somewhat commonly tested area, right? Commonly tested area. But ECL, they have tested if I'm not mistaken, 2 to 3 times. Very small conceptual questions. But the examiner comment first, I can clearly remember, students have not provided the correct answer. His answer for the ECL question is unsatisfactory, right? Derivative and hedge accounting, so far in near past, they have not tested a derivative and hedge accounting. And this time, when you read your pre-scene, EOS in equipped solutions, right? That pre-scene, you can see there is a problem that parent company is facing, just because the forward rates cannot be obtained and the exchange rate fluctuations are there. And there's a problem which the company is encountering at the moment. And there is a possibility that examiner will test from derivative and hedge accounting, right? So be mindful on those three areas as well. So I can say all these three areas are very much important. But a derivative, of course, I can't speak at the moment, because this I have to go through the other parts as well, and other questions as well. But I will give a brief introduction about the financial asset and liabilities. So when it comes to financial asset and liabilities, student, the most common thing is financial assets. So financial liability and equity instrument, there is a problem with classification of financial liability and equity instrument. So I think you can go ahead with those things in your study pack, and some maybe webinar series it was mentioned there. And when it comes to the financial assets, I want to mention about the financial asset, just because this question also relating to financial asset. Financial asset is, student, basically you have equity instruments. As well as debt instruments. The standard says if it is an equity instrument, the default option to classify equity instrument, let's say ordinary share, if it is an equity instrument, the default option to classify is fair value through profit and loss. Default option. But if you have some kind of a strategic motive, not for trading motive, or if you want, and you can irrevocably select to classify that financial equity instrument under fair value through OCI. This is a misconception, students. Sometimes you all are having. You might think fair value through OCI. If it is a long-term purpose, fair value through OCI, it is completely wrong. Even if it's a strategic motive, you can still show under FVTPL. It can be done. But what you can do is, if you want, you can select. It's an optional thing to show it under fair value through OCI. Irrevocable. Irrevocable means you can't reverse. Put it there, it is gone. You can't reverse. And when it comes to debt instrument, student, we have the famous tests. 2 tests, contractual cash flow test, or we call SPPI test, or we have the business model test. So basically, you can segregate or you can classify the debt instrument using contractual cash flow test and business model test, right? Here, student, when it comes to debt instrument, first you are asking the SPPI test. sole payment through principal and interest. If the SPPI test is no, obviously if it goes to FVTPL, financial asset. If the SPPI test is yes, you are asking another question. Business model objective is to keep it until maturity and collect the cash flows. If it is yes, the answer is amortized cost. If the business model objective is to keep it until the maturity and collect the cash flows or sell whenever there is an asset arise or when there is an opportunity to get more return by selling the asset, then what you are going to do is you are going to show it under fair value through OCI. So what is happening here? Business model objective both to keep, and if there's a more profitable investment option, you will sell it. So both options are there. So if these are not satisfying, no. If it is, obviously goes to fair value through profit and loss. So there are a lot of things we need to discuss actually, not in this forum. Financial asset designation, a lot of things are there, but I think this knowledge is enough. So when other thing is, when it's come to impairment or the expected credit losses, I want to give you some introduction about the expected credit losses, since I believe most of you are not that much aware about the expected credit losses. That is why I thought of giving some kind of introduction. So basically, student, we have 3-stage approach when it comes to impairment: stage 1, stage 2, and stage 3. So earlier, when we have the LKS 39, we had something called incurred loss model, but now we have expected loss model. You have to think about the future. Incurred loss model means you just decide the impairment provision just looking at the past, but expected credit loss model means basically, student, you have to think about the future. It's very important, right? So here, stage 1 means basically, so some student is asking, someone is just now joined. Can you share the first part? I think institute has arranged to share this through YouTube. I don't know anyway. I will let them to decide that. Anyway, you can contact the institute and you can ask it from. Right. So stage 1, stage 2, and stage, like 3 buckets student we are having. So what is happening? So I don't have a lot of time, student. That is why I am rushing through these things. I know somewhat you feel difficult to understand, but if you can't understand, try to get the substance by looking at the study pack. And there are a lot of webinar series and a lot of materials available outside. Maybe referring to some of your theory class, that is also good. So you get the knowledge, but I will refresh the knowledge which is required to construct me the answer for this question. So student, stage 1 means basically credit risk not increase significantly. Credit risk, what is mean by credit risk? Risk of not paying. Let's say risk of not paying. Credit risk not increase significantly. If it is not increased significantly, you are keeping that particular financial asset under stage 1. So which asset this impairment is valid? Impairment is required for, not for the equity instrument. Equity instrument, we don't have impairment requirement. Earlier standard, we had something called significant prolong, but new SLFRS 9, we don't have impairment requirement for equity instrument. Impairment requirement comes for debt instrument, which is classified under fair value through OCI and amortized cost, not even FVTPL. 2 things: fair value through OCI, amortized cost, the ECL requirement comes. So whatever the financial instrument, that debt instrument, the credit risk is not increased significantly, you have to show it under stage 1. If the credit risk has increased significantly, credit risk has increased significantly, significant increase in credit risk, we call significant increase in credit risk, SICR, you have to put it under stage 2. You have to put it under stage 2. And if the facility is default, if the contract is default or credit impaired, you have to show it under stage 3. Let's take a simple example. There is a loan given by the bank. For that bank, loan is a receivable from customer. And it is mentioned under amortized cost. Loan is showing under amortized cost. That particular bank loan is not paid by the customer, let's say 30 days period. So last payment you got before 30 days. 30 days period, customer is not paid. Then if the customer is paying very well, the customer is in stage 1. Customer is not paid for 30 days. It goes to stage 2. There is a customer who has not paid for, let's say, 90 days. That particular customer goes to stage 3. So basically, student, whatever the financial instrument, you have to classify under stage 1, stage 2, or stage 3. So then only you can determine the expected credit losses. So this 30 days, where this 30 days came? It is coming from my mind. No, student, the standard says a rebuttable presumption. A rebuttable presumption. If you want, you can change. But it's a rebuttable presumption that within 30 days, someone is not paying. If it is not paid within 30 days, it is stage 2. Rebuttable presumption, 90 days, it is stage 3, default. So what is happening, student, in the industry? So normally in the banking industry or the finance industry, we are using these terms very well. Stage 1 we call performing facilities. It's a performing financial instrument. Stage 2 we call it's underperforming, and stage 3 we call it's non-performing. So these are practical things. Believe me, student, very important. Even in the examination, very important, these things. Even you think this is not mentioned in the standard, it is very important. Why? I will tell you the good example. Here, student, I can remember in one past paper, how the expected credit loss compute. It compute by multiplying 3 things: exposure at default, probability of default, and loss given default. Believe me, student, these terms were tested in the previous past paper, right? So exposure at default. What is mean by exposure at default? Basically, student, exposure at default means not a rocket science. It is the carrying amount at the reporting date. Let's say you are the bank. There is a customer who is not paying. Whatever the balance outstanding from that customer, that is what we call exposure at default. Balance outstanding balance. Or if it is a trade receivable, the trade receivable balance. PD. What is mean by PD? Probability of default. What is the probability that customer will goes to default? Default means customer will not pay. Let's say you have 1,000 worth of exposure. What is the probability the customer will not pay? Let's say 50%. The probability is 50%. It means, let's say 60%. It means you can collect 400. But remaining 600, you can't collect. The probability of default. There are a lot of statistical models there to compute these things. Those things weren't tested from you, student, but you have to have some basic understanding. Loss given default. What is mean by LGD? Loss given default. If customer goes default, to this stage 3 default, bank is not waiting. They will take a lot of recovery actions. Maybe repossess the vehicle, maybe take the ownership of the property, because there are a lot of underlying assets, underlying securities. They will put some legal action. Likewise, they will take some recovery actions. By doing some recovery action, even though here the 600, whatever the amount, let's say, whatever the EAD is not recoverable, some portion by selling the underlying securities, likewise, some portion you can recover. And he call it LGD. Let's say LGD also 50%. There are a lot of ways that you can find. Then the multiplication of these 3 is becoming the expected credit losses, student. So what is the beauty is, student? Normally, if there is a customer, if there is a facility in stage 1, probability of default, let's say 10%. It means the customer is paying well. There's 10% probability or less than 10%, let's say 1% probability that he might not pay. If he is stage 2, what is happening to the probability? So can someone tell me, student, if someone is in stage 2, what is happening to this 10% probability? So can any student tell me what will happen? The probability will increase, definitely will increase. It will ended up with 50%, let's say. So what you can say about the stage 3, what is the probability of default? Probability of default in default stage, what is the probability? Is 100%, student. When customer comes to default stage, there's no probability he is in default stage. 100%. PD is 100%. Just a matter of deciding LGD. So if it is in stage 3, its the probability of default is high. So how you can say the customer is in stage 3? Again, standard is providing some guideline. Listen very carefully. If customer is facing significant financial difficulty, is stage 3. If customer is bankrupt, is stage 3. And other thing is customer has breached the contract, is stage 3. And other things, customer is having some kind of a moratorium, like classic moratorium, debt moratoriums we had these days, right? Some concessions. or we can reschedulement of loans. Those things also provide indication that customer is in stage 3. Stage 3. So with that, student, we will go to our context. Our context. I think I have given reasonable guidance. So sorry for if you haven't understood the student, because the time is limited. So I have to do this very fast. That is why I'm going very fast. Right. So here, student, we'll go to the question. On 1st April 2020, Fortune X PLC purchased 2 million listed bonds. 2 million listed bonds, Gamma PLC, LKR 50 each. 50 each. Right. It means 100 million worth of bonds they have purchased. Coupon rate is 5%. Coupon rate is 5%, while the bond are expected to be repaid in 1st April 2023. So 2020 purchase, 2023, after 3 years, you are required to, you can get the maturity proceed. You can get the maturity proceed. But LKR 55 each. So what you can get, 2 million into 55 each, you can get 110 million. 110 million. That is okay. Effective interest rate, bond determine 8%. So effective interest rate is given. If it is not given, you have to find the IRR. IRR becoming the effective interest rate. But don't worry, in the physical examination, they don't want you to find the IRR. If it is online examination, since the Excel is there, they may ask. But in a physical examination, normally the IRR is given to you. Fortune X PLC business module is to collect cash flows from the above bond over lifespan of the project. So what you can tell student? So this is a debt instrument. So what you have to do, you have to send it through business model test and contractual cash flow test. Obviously, contractual cash flow test is satisfying. Why? Sole payment through principal and interest. There is no share option conversion, right? Is not a convertible bond. There's no any other payment methods. Only the interest, which is meant by coupon, as well as the principal. So SPPI test is satisfying. What is the business model objective? Business model objective is to keep until maturity. So what is the best classification, student? Best specification, I need the answer from you. What is the best specification? Amortized cost, Ravindu, rest, absolute right. Then, as at 31st March 2021, Gamma PLC paid a coupon, right? At the end of the first year, they paid the coupon. However, same date, it was revealed that Gamma PLC is facing significant financial difficulty. Credit risk associate bond is very high. So what is the stage, student? When it comes to the reporting date, what is the stage? Yes, Sahara, it is stage 3. Stage 3. So actually, student, I don't know whether you have noted this question itself having some kind of a printing and oversight mistake. The question itself is so having oversight mistake. So, okay, so I will show it to you. Accordingly, it is estimated that present value of cash flow from the bond in to be ended 31st March 2022. So what is happening, student? The face value of the bond is 100. Coupon is 5%. It means, and what is the annual coupon payment? 5 million. So annual coupon payment is how much? 5 million. 5 million. So what they are saying, the present value of the cash flow from the bond ended 31st March 2020 will be 5 million. Can the present value also be 5 million? But you can say, student, no. Present value should be less than 5 million. So what you need to do? This present value, student, you need to correct. It should be 5 million divided by 1.08. The present value is 4.63. So make that correction, student. It's some kind of a typing mistake. 4.63. 4.63 need to be corrected as 4.63, right? With the probability of default 3%. Actually, this is also incorrect. This is also incorrect. So what is the probability of default? Since this is the financial difficulty stage 3, it is 100%. It is 100%. Probability of default we are not required to have. It is 100%. In addition, it is expected that in year to be ended 31st March 2023, the coupon payment will be defaulted. So no coupon payment for the final year. And the present value of bond repayment, out of this 110, you will present value of bond repayment, cash flow will only 80 million. Anyway, final year, you will not get the 5 million, whatever the coupon payment as well. Out of this 110, you will get 80 million. And this is the present value. That is okay. That is okay. With 5% probability of default, again, this is not required because we know since this is stage 3 as 100% probability of default is there. Advise the bond, how the above bond should be treated in the financial statement. Right. So I am sharing the Excel, student. Hope you all can see the Excel file. Hope you can see the Excel file. So what is happening? This is a summary I have given. Right. Initial recognition. Initial recognition should be at amortized cost. Amortized cost. So what is the initial recognition? 50 into. So initial recognition, amortized cost. So, sorry, not initial recognition, amortized cost. I have mistaken. It's fair value. Sorry. Initial recognition, fair value. All the financial instrument initially recognized at fair value. And transaction cost also need to be added since this is amortized cost facility, but FVTPL transaction cost goes to P&L. So I'm correcting that mistake, student. Initial recognition should be at fair value. So what is the fair value? Fair value means the price that you pay. You pay 50 into 2, 100, and the transaction cost. Do we have a transaction cost, student? Do we have a transaction cost? No. Since we don't have the transaction cost, initial recognition is at 100, right? So what you need to do is, student, subsequent measurement, you have to prepare an amortization schedule. So we will prepare an amortization schedule. So amortization schedule start with 100, and interest need to be recognized based on EIR, not based on interest should be recognized at EIR, not based on the coupon rate. So 8%, right? And the cash flow, what is the cash flow? So what is happening? This 100 million, annually you will get 5% coupon payment. It means 5 million is the cash flow. You can put cash flow as the 5 million, and you can take the balance carried down. And this is the balance which should be reflected in the financial statement as of the reporting date. So the second year also you can compute 8%, and the cash flow remains same. So you can drag this, and the final year also you can compute 8%. And the cash flow, what you can say about the cash flow? Now, this 5 million pass, the bond is maturing, and at the maturity, they will agree to give 55 into 2 million, 110. And the maturity, the cash proceed is, cash flow is 115, and it becoming zero. Amortization schedule required to be zero. Otherwise, your answer is incorrect. Answer is incorrect, right? Now that is done. That is done. Now what they're asking? ECL assessment. ECL assessment. So student, when it's come to expected credit losses, so I will go to the theory again. So I have given you the theory as well. These things will be shared with the student when they have the suggested solution. Financial asset, let me measure that both following conditions are met: business model test and contractual cash flow test. We have discussed this already. And initial measurement, financial asset amortized at its fair value plus transaction cost, we have discussed. Subsequent measurement at amortized cost, and interest should be accrued based on EIR. That also we have discussed. Anyway, so here student, SLFRS 9 say following asset be suggested credit impaired. So I have discussed these things as well: significant financial difficulty, breach of contract, concessions, becoming probable, bankruptcy. So those things. So what is happening, student? If the asset is credit impaired at the reporting date, expected credit loss should be measured at the difference between gross carrying amount and the present value of expected cash flows. So if it is a facility which is classified in the stage 3, you have to take two things: gross carrying amount and the present value of future cash flows to determine the expected credit loss. Another thing is, student, when it's come to stage 3, I forgot to mention, stage 3, there is a special requirement of interest income computation. Normally, how we compute interest income? If it is a total receivable, we multiply it by the interest rate and you compute the interest income. But here, if it is a stage 3, there is a requirement. What you have to do: total receivable minus impairment provision or expected credit loss provision you have already recognized into 8%. We call net carrying amount. Net, not the gross carrying amount, net carrying amount basis you have to recognize revenue, right? So that is there. So student, we will go to the Excel again with this understanding. So here, student, what is the expected cash flow? First year, so we have, I told you, 4.63 will be received. And the next year, you will receive 80. So what is the expected cash flow? Only 84.63. Carrying amount, what is the carrying amount? Carrying amount is at the end of the first year, this is happening 103, right? So what is the present value of expected cash flow is 84. The difference between the carrying amount and what you can get, this is the expected credit loss. Double entry. So ECL provision credit, P&L debit, P&L debit. So the next year, can you recognize this interest expense? Sorry, not this interest income. No. For the second year, what you have to do? You have to recognize interest income on net basis. How to recognize the net basis? Gross carrying amount minus this ECL provision. This amount into 8% only you can recognize the revenue. You can't recognize the revenue 8. You can recognize the revenue 6.77. Hope you understood it, student. So we will move forward. Right. So I am taking a lot of time, student. I think Suranga sir don't mind it. Right. Anyway, student, with this question, I will hand over the battle to Suranga sir. So this is the question. We will do this and I will hand over the battle to Suranga sir. Then after that, I will come in again. Right. So here, student, question number 2. So this is all about the retirement benefit obligation. So normally, student, retirement benefit obligation question is not that much testable in strategic level paper, but this is common in corporate level paper. But we'll do, because sometimes, since the examiner is doing some other areas as well, testing other areas as well, there's a possibility to come. And this is some kind of an extremist case when it comes to retirement benefit obligation. It is not a simple question. Believe me, it is some kind of a difficult question we have, right? So here, student, when it comes to retirement benefit obligations, we can count retirement benefit obligation, student. It's actually LCS 19 we are talking about, LCS 19. When it comes to LCS 19, employee benefits, actually the standard talks about 4 employment benefit types. The first one is short-term employment benefits. The next one is termination benefits. The next one is retirement benefits. And the final one is other long-term benefits. Short-term benefit mean basically, student, the salaries, OT, and any other bonus like the short-term benefit you are getting. Termination benefit means it's like by forcefully you are retiring. It's like forcefully you are going out to the company. It's a termination. Forceful retirement we call termination. Maybe some penalties, voluntary retirement schemes, those things are captured under termination benefit. And retirement benefit obligation means normally if you are retiring, what are the benefits you are getting? Other long-term benefit means the catch-all clause. If something is not catching under these 3 terms, it is go to other long-term benefits. When it comes to retirement benefits, so that's why most of the time we say LCS 19 is all about retirement benefit obligation. Why? The retirement benefit is more discussed. Why, student? Most of the time retirement benefits, we have a lot of complex things to discuss. So retirement benefit, student, also can divide into 2, defined contribution plans and defined benefit plans. Defined benefit plans. If I define these words in simple terms, defined contribution plan means the word itself is having the definition, defined contribution. The contribution is defined. The value of the contribution is defined. The example, EPF and ETF. The contribution is defined, 10%, 12%, 3%. The contribution is defined. And what is happening? If it's a defined contribution plan, but the company is liable to deduct it on monthly basis, send it to some other organization in Sri Lanka, EPF fund. They are sending. But after that, company doesn't have any constructive or legal obligation to pay the employees at retirement. So after retirement, are you going to the company and ask for the EPF, or are you going to the EPF fund and ask? You are going to EPF fund. So after retirement, the company is not liable to pay for the employees, but the contribution, of course, they are liable. That is what they call employee contribution plan. Employee defined benefit plans, basically, student, defined benefit plans are not that way defined. If they say if it is not a defined contribution plan, obviously it's a defined benefit plan. So what is happening, student? Defined benefit plan, the whatever employee is liable to pay the employees. They have the constructive and legal obligation upon the retirement to pay. So that is the difference. Then example is the gratuity. But good example that I can give is gratuity. So what is happening, student? very much focus goes, not even for the defined contribution. The highest focus goes to which student? Defined benefit plans. Why? This is the point where most of the other benefits you recognize on undiscounted cash flow basis, but here discounted cash flow techniques are involving, and we call it actuarial valuation. So you are not required to perform actuarial valuation by your own, but you have to be mindful. You have to have the ability to read the valuation report produced by the actuary, and you should be able to provide a disclosure based on that actuarial valuation report. So here, student, when it comes to actuarial valuation and defined benefit obligation, what is most common? So normally, if you are working in an organization, the retirement benefit obligation, the liability part is common, the gratuity liability part is common, but there's some other part also which is called plan asset. So luckily in my organization, I have a plan asset. So I know in and out about the plan asset, but most of the organization in Sri Lanka, student, doesn't have a plan asset. Plan asset means basically, student, the company is having the liability. So gratuity, who is having the liability, who is having the obligation? The company. What they do is they transfer some of the money to a fund, let's say trust fund, some other organization called plan asset. What they are responsible. So student is asking, so should we have to consider the probability of default when getting the ECL? That's why, student, I have mentioned, Ravindu, the previous question. If it is in stage 3, the probability of default is how much? Stage 3. Significant financial difficulty means stage 3. If it is under stage 3, it is already impaired, it is already default, then probability of default is how much? 100%. So that question is having a conceptual mistake. What is the mistake? They have given the probability of default ratio, and which is should not be there. So I think I have provided the answer. Right. Okay, student. So here, what I have mentioned basically, the plan asset. If you have the plan asset, what is happening, student? Gratuity, the company liability remains same. But if you have the plan asset, what you have to do? You can offset and show. So normally accounting standards are not permitting the offsetting. Under conceptual LKS 1, it is offsetting is not permitted. But this kind of a situation, offsetting is permitted. So I can't explain this more, student. So what I will be doing this, I will go to the question. So here, student. Right. So the remaining. So we will do this one as well before coming to the question. This theory part as well. So action verb prepare. It's tier 3. So make ready particular purpose. So you need to prepare. A disclosure. That is the ultimate purpose of this question. So actually, some words that you need to be understand. There's something called asset ceiling, student. What is mean by asset ceiling? Let's say you have a retirement benefit obligation 100 and plan asset, fair value of the plan asset is 120. Then what is happening? Instead of a liability, when you netted off, this is the liable, this is the asset. What is happening? That's having a retirement, instead of retirement benefit obligation liability, that's having a retirement benefit obligation asset. That can happen just because the planned asset is having some financial instrument. They may be measured at fair value basis. The market price goes on just because of the planned asset value increase. That can happen, right? So here, this 20% asset is there now, but the standard says when you have an asset, not a liability, when you have asset, there's a ceiling. There's a maximum amount that you can recognize the asset. So what is the maximum amount? Amount calculated as normal. If nothing has mentioned, 20 rupees you can identify as the asset, or else total present value of the economic benefit available in the forms of refund and reduction in future contribution. So what is happening? Basically, student, you should have some kind of a ceiling limit. What is the limit? It should be limited on up to whatever the present value that you can, economic benefits that you can get in terms of refund. Let's say this 20 rupees, out of this 20 rupees, only 10 rupee you can get as a refund. If you want to get a refund, only 10 rupee you can get as a refund. Then up to 10 rupee only you can recognize the asset. There's asset ceiling. Let's say other thing. this 20 million, normally if you have a fund, the company annually need to contribute some fund, annually need to pay some money to that fund, plan asset. So the plan asset is saying, okay, we have a 20% positive figure. You are not required to pay 20 million, let's say 20 million in next financial year. It means you are not required to pay 20 million contribution in next year. If there's a reduction from the contribution, future contribution, that can be put as a ceiling. Let's say just because of that contribution reduction is only 10 million. Then again, what is happening? The ceiling is 10 million. You can't recognize this asset amount into 20 million. You have to limit it for 10 million. So I think I can describe it further, but the time is limited, students. So I will move forward. And there's something called curtailment. Curtailment is basically curtailment is a significant reduction in number of employees covered by the pension plan. It is basically curtailment means the benefits are curtailed. You are limiting, you are reducing number of employees who are eligible for gratuity. That is what we call curtailment. And settlement. Settlement means use settlement occurs when entity enters into a transaction, eliminate the obligation part of the benefit. The settlement means in between, let's say somewhere in between, before he is retiring, you pay some amount as settlement. You pay some money. That is what we call settlements, right? So I want to discuss those things in detail. If you can't remember, you have to go to the theory and you have to watch. You have to revisit those things. I will quickly go into the question, student. Right. So Blooms Limited prepare a defined pension scheme for its employees of 1,971. Sorry, 1,971. The board of directors of Blooms decided that above scheme will not be extended to the new employees of the company from 1st April 2021 onwards. So the remaining employees, they will not extend. What is this? This is a curtailment. This is a curtailment, students. So curtailment that I have mentioned in the theory is a curtailment. Hence, the new employees are only entitled for employee provident fund, where the company will contribute 12% of the monthly salary. So here the EPF fund is there. This is a defined contribution plan. Fixed contribution is there, defined contribution plan. So this 12% recorded as defined contribution plan. So it is not our question. So we will read forward. On 1st April 2020, it is a reporting date, not the reporting date, financial statement. The financial year starting date. This is a financial year starting date. The fair value of the asset of the pension scheme 350. Fair value of the plan asset 350. While the actuary estimated that present value of the pension liability is 300 million. So this is the retirement benefit obligation 300 million. So we have the retirement benefit obligation is lower than the asset. We have a ceiling requirement comes in. In addition to this estimate indicated that 1st April 2020, the present value of future refund from the pension fund, any reduction in the future contribution to the plan will only be 25 million. So what is happening is, student, you have a liability of 300. You have asset of 350. It means ultimate you have a net asset of 50, but you can refund only, you can reduce the future contribution only limited to 25 million. It says 50 million you can't recognize, student. It should be limited to 25 million. Asset ceiling requirement of 25 million comes in. Right. Present value of the plan asset. This is at the reporting date. The following assets are relating to year-ended reporting date. Present value of plan asset 340 million. Present value of liabilities is 305. That point also you have some kind of asset and it is also subject to some ceiling. Present value of future refund from the pension fund. So any reduction in the future contribution is only 27 million. Interest rate applicable 8% per annum. Current services cost 25 million. Contribution paid to plan. So the company has to pay annual contribution to the plan. I have mentioned it. It's 35 million. Benefit paid from the plan during the year 50 million. Let's say this is the gratuity payment or pension fund payment, right? This is 50 billion. Reduction in liabilities due to pension scheme curtailment is 35 million. This is the curtailment. This is the curtailment cost. Payment due to pension scheme as compensation for curtailment. This is the settlement. Settlement 45 million. So believe me, student, I haven't seen any students has provided the correct answer for this question. It is really sad because I have seen some answer scripts. I haven't seen any of you have provided the correct answer. So maybe I have checked only few answer script, right? So no one in that answers provided the correct answer. Even this, I believe this should be a question to be tested in corporate level. Corporate level students also need to have some kind of an understanding to give answers for this kind of a question. But still, even you are in strategic level, you don't know this basic. That is why always telling, don't do selective learning. Don't do selective learning. When you are learning, anyway, before the examination, you might have to focus some areas, but other than that, so these things you have to be aware. These things you have to be aware. After becoming a chartered accountant, if you don't know the this kind of a disclosure, no point, student. It is no point. So you have to maintain that quality as well. So basic things very important, very important. And other thing is, student. So what is happening most of the time when it's come to the examination paper, you are always expecting that similar kind of a question which was there in the study text, which was there in the revision quiz, which was done in the webinar series, done by class lecturer, will come to the examination, and it will not going to happen. Not going to happen. Let's say if you are working as a chartered accountant, even we also coming up with some problems, students. What we do, we go and refer the accounting standard. That approach also you need to follow. You need to follow everything. You can't learn in a classroom environment or study pack environment. So you have to think logically. Don't go by heart learning. Logically think accounting standard. Then only you can be a chartered accountant. Not a chartered accountant, I believe, a quality chartered accountant. Right, student? We will move forward. Present value of retirement benefit obligation. So I have laid down a summary here. So opening date. So we'll forget about the curtailment. We'll forget about the ceiling requirement. We'll do just prepare a note. So I will do this here. Opening balance. What is the retirement benefit obligation? It is 300. Fair value of planned asset 350. So what is happening is, student, before ceiling, you can recognize the retirement benefit obligation minus fair value of net asset. This is the opening asset position. So we will do the ceiling later, right? Fair value of the planned asset 340. At the closing balance, it should be 340. Not. Fair value of planned asset should be 340, and fair value of the retirement benefit obligation should be 350. Hope you all can see the Excel. I'm in the Excel, right? And interest rate 8%. Interest rate 8%. Here is, student, you have to take the interest rate at the beginning of the reporting period, not at the end of the reporting period. Beginning of the reporting period. Here they have not mentioned if there is beginning or end. We have to think this is beginning and end, same interest rate is there. But if you have two interest rate, take the beginning period interest rate. So what you have to do, you have to compute the interest cost. There is a liability. That liability you have to accrue the interest cost multiplied by 8%, right? Interest cost. There is a planned asset. Planned asset is coming some kind of a return. That also need to be multiplied by 8%, and this is the interest income. This is the interest income. So don't go and take the actual interest income received by the planned asset. Let's say the planned asset invested in fixed deposit. Don't go and take the actual fixed deposit interest that you have received. It should be multiplied by the opening date discounting factor, or the interest rate, and it should be computed in this way. So that also liability minus liability interest cost minus income, you have to put the total. Current service cost. What is meant by service cost? Just because you are providing the service to the company, 1 year passed, the additional service you are providing as employees, service cost is generating, it is 25 million. Just because of the service cost, what is the double entry? What is the double entry? P&L debit, retirement benefit obligation credit. P&L debit and debit under personal cost. So this is a double entry. So there is no impact to the plan asset. So I put that as well. P&L debit, retirement benefit obligation credit, right? Then contribution to the plan. You pay money to the contribution. What is the double entry? What is the double entry? So here, student, fair value of planned asset. Actually, planned asset debit and credit to where you pay cash credit. Right. So what is happening? Contribution paid to the plan, it is 35, right? 35 million. So you put it to here. The benefit paid, the pension benefit paid. How do you pay benefit? So when the benefits are paid, the liability goes down. Liability goes down. Out of which you are paying, not with your money. Who is paying now? Paying by the plan asset. So what is the double entry? Return benefit obligation debit, plan asset credit, plan asset credit. So this is the double entry. So anyway, all those things you have to take the net balance, curtailment and settlement. So there's a curtailment. What is the curtailment? It is 35 million. So liability is curtailed by 35 million. It is added here. And the settlement goes with the planned asset. It is deducted from the planned asset. Right. Done. Now that is okay. Now what you can do, you can take the total. And then what is happening, student? You can see a difference. So here, student, here it is not 350, it is 305. Right. You take the net balance as well. You can see a difference. What is this difference? What is this balancing figure, students? Can someone tell what is this balancing figure? Can someone tell me quickly what is this balancing figure? It is the OCI, absolutely right. So balancing figure is OCI, actuarial gain no loss. So you can calculate actuarial gain no loss in this way, right? So before ceiling, this is the case. Now we will go and adjust the ceiling impact. So what is happening? At the opening date, you can only keep 25 million. It means what is the ceiling adjustment? You can only keep 25 million worth of asset. Then what is the ceiling adjustment, student? Ceiling adjustment is 25. So ceiling adjustment is actually 25. So 25. Then only the figure is coming. So ceiling adjustment is 25. So you can keep only 25. Then what is happening is, student, ultimately closing date also you can see. Closing date. What is the closing date? They are saying 27. Only 27. Then what is happening? Here you have 8 difference. After deducting the ceiling of 8, you can bring it to 27 million. But you have to fill in between the figures. What they say. So interest cost you need to compute. For the ceiling, you need to compute interest. It is 8%. For the ceiling, you need to compute the interest, 8%. Then what is happening? If you can get the total like this, right? Total like this. Then what is happening, student? It is 27 now. So 27 to 8. What is the ceiling adjustment goes to actuarial gain no loss? It is 19. And you will get the 8 figure. You will get right. So here, student, if you want, you can multiply these also as well, and you can see what is the ultimate impact. So after ceiling, this should be the balance which should reflect. So if you are producing a disclosure, these entire things need to be mentioned in the disclosure. So what is the ceiling adjustment? Opening you adjust, closing adjust. Then what you do? Interest income adjustment for the ceiling. Then come to the down, and actuarial gain all of ceiling adjustment. Then the disclosures done. So with that, student, I will be finishing the first part, and I invite Suranga sir to take over the parts, and he will discuss entire risk of material misstatement part. After that, I will take you through the consolidation, the favorite consolidation question. Okay, Suranga sir, over to you.
Yeah, thanks, Chamut. I think you did a very good job, not only by covering the relevant questions, but giving them the overall idea, and also very valuable suggestions to improve their confidence. So you can hear me, right?
Yes, sir, audible. You are audible.
Yeah. So let me share my screen. Can't share my screen. I think, are you still sharing screen, Chamat? Yeah, now I can. So I
I have
hope
stopped
you
this, sir.
can
Right?
see my screen. Yes, now you can see the screen, right?
Yes, sir, it's visible. Right.
Okay, thanks, Jamal. So basically, I will take you through the questions, allowing you sufficient time because I know, like Chamath rightly said, the consolidation is definitely an interest area. But like I said at the outset, don't forget 45%, right? You can easily score if you approach strategically. I repeat that. So therefore, some of these questions, another advice, see this paper, I mean, this has been done within a shorter period of time. If you compare some of these questions, the exam standards may be a little different. Especially, I want to draw your attention to corporate governance. This is a straight questions. You know, I can explain to you in 5 minutes. But the thing is, these type of questions, if you look at overall, there is ethics question for 5 marks. What it says, basic action verb of explaining the threats to fundamental principles, right? 5 marks. I mean, any students who is basically thorough with ethics can easily get these 5 marks. So there is a secret behind scoring. It's all about the speed, the very challenge. Ask the fundamental question why this is the paper with the lowest pass rate when the new syllabus comes, right? One of the lowest pass rate. The simple reason is students can't manage the time because a paper that involves calculation, interpretation, and a case study type answers, essay type answers, how do you manage the time? So, like Chamath mentioned earlier, if you happen to refer to books while in the exam, that can lead to a disaster unless you exactly know that you are looking a book for a purpose and you know particular page and you don't copy paste, but you know how to take part of it and explain your answer. So those skills are very important. I would probably say that this section of the syllabus will really help you to pass. While it is a prerequisite for you to be thorough with consolidation and accounting standard, if you don't take this seriously and prepare, you are in trouble. So this is a pilot paper. Compare your answer now. So I am going to take you through, give you the confidence to write an answer without looking any books, right? And to be able to, again, there is art of doing that. So what is required is your confidence and to have certain fundamentals in your mind. So I will take all these three cases quickly. One is on ethics, one is on governance, the other one is on integrated reporting. So there's an interesting question, but I with the case study. But here, I think this question need to be enriched with another case to demonstrate how integrated reporting is applied. So without that, there is a question, but that question is a rich question which we can discuss. So like I said, the purpose is to develop answer with confidence without any books and to score as quickly as possible about 30-40 marks. That's the task that I am going to do. So start with ethics. If you straight away look at the question, say simply explain. It's I mean, the while explain is not a high level action verb like Chamath explained earlier, like a synthesis level. This explain is a basic kind of conceptual, and this question is not really conceptual, but you have to apply. So how do you apply fundamental ethical principle to this scenario? How to write very quick answer to get 5 marks? Can you get that in 2-3 minutes? We'll see. The next question, see, first of all, be very happy. Okay, there's a small paragraph. I can easily write. Any students who know ethics, this 5 marks is very sure, right? At the same time, if you look at the other part, there is no case study. That's why don't underestimate the pre-scene that has been already released. So there can always be corporate governance can come with a case study. But this is simply this question simply says there is a company and they are evaluating, they are going for a listing and they want to form audit committee and the board is not clear about the composition, competence. So this is a very basic primitive question from governance. For your level, you should expect a very rich question than this. But anyway, if a basic question like this is given, you should have easily answered. So the question is prepare explanatory note to the board explaining the guidelines on establishing an audit committee and benefits. So that there are two elements of this question. The reading is very important, otherwise you will not get 5 marks. To get about 2.5 marks, you have to explain the guidelines. So what do you mean by guidelines? So that relates to corporate governance requirement, right? So again, are you going to refer your book, or can you just write an answer? So I will write answer here itself, right? And basically it's a high level answer which you can easily convert with another sentence to a complete answer and get 5 marks, right? One is a guideline. If you only talk about guidelines without looking the benefits, you will get about 2 marks, so 2.5. So the benefit probably will carry about 3 marks. So you need to really be mindful about how marks can be allocated, right? The third one, ideally there has to be a case study here. So I think there is an improvement to be done. But as a question, see, I am giving you that information which is missing here. If you assume that this company, you are the CFO and you have been asked to produce the first set of integrated report because the board of directors believe that the integrated thinking is going to really help the company. So the question is, demonstrate how organization create or diminishes value using multi-capital approach connected to business model. Now you will see, okay, what are these words? Some of you will ignore this question, but it's so easy question to get 5 marks. In a case study, this can be a 10 marks question, perhaps. So now what are the keywords here? Create value using multi-capital approach. So when you look at that, you should recall the types of capital, 6 capital in integrated reporting model, the business model, immediately that picture should come to your mind. From that, you should be able to write few points and get another 5 marks. So I'll show you how to do that. So that is 15 marks during next 10 minutes. Let's score 15 marks, provided you have some fundamental knowledge. So let's look at the first question. The first question is Roman, an associate member of the Chartered Institute, right, working as a financial controller of the company. Now see, this is ethics is applied in this context to a financial controller. While being the financial controller, he works as a partner in an audit firm. That firm is run by the spouse. So already you can see, now you have to relate this to fundamental principles, right? So I am sure all of you know what fundamental principles are. And the threats, what are the threats? Your answer should definitely connect threats to principles and derive an answer. But before that, we need to see what are the issues. So what? What's the problem? Is there a problem? So can you use the chat option and tell me which principles are at risk here as ethical issue? What are the threats? If you use the threat framework, when I say threat framework, so I go to this Word document and just write SASSify, right? So these are no books. This is the threat framework, right? So self-interest, right? And advocacy, self-review threat, likewise, you know, familiarity and intimidation threat, right? So now, can you tell me in this case study, what are the threats you are going to relate this case study to? As we read it, now one is he's a CFO and working in the audit firm as a partner. Then the managing director of this company, who is a very close friend, or there is a close relationship with the financial controller, he suggests the person to provide an assignment for review of financial statement. Now imagine he is in the company and he has been asked to review the financial statements of the company, not he, probably his firm, which is run by the spouse, right? So that is the firms, right? And to quote a fee. So what? How do you write answer to quickly get 5 marks? So can some students write? Can I get some response about the? Yeah, there are answers to say self-interest threat, self-review threat, right? Objectivity. So there are a lot of answers, right? So you have to be very confident to relate this to the answer. First of all, ask the fundamental question. Don't put theory first. Look at the issue first. The issue is, one is, can the CFO, right, while doing the financial controller, right? While being a financial controller, running a firm as a partner, what is the very first issue you should highlight? And those words, paper marker will specifically look at. This is a famous word in ethics. While it is self-interest, so what? That is the problem, like what? Conflict of interest. Because let us say uh, the time he spent on his job, he can't handle his job properly because while at the work he is attending to wife, spouse, firm's activities, right? Where the job interest is affected by personal interest to run the company. So now you answer, one part of the answer is to say there is a, so now you have to say the self-interest is a threat. Which principle is going to be affected? Now because of that self-interest, let us say he's going to have inadequate time to do his work at office, that is going to affect his professional competence, right? Because he will not put adequate effort and do the work diligently. That is one aspect, right? Then the other one, of course, if others realize, look here, chartered accountants, they are doing, double hatting. While working as a FC, they are running another business. So that tarnish the reputation of chartered accountants. So that you can even relate to professional behavior. See, if you are a student who can think, you can easily relate this and write the answer. So the first statement you may write in your answer is to say that because I forgot his name, because Roman, right? As Roman, so I will not write everything because it will take time, but I'm reading for you to make note of these answers, right? As Roman plays both, as Roman undertakes a personal role while being the CFO, right? There is, now I'm connecting the answer, there is a self-interest threat, right? So within bracket, you can say conflict of interest, which could affect his professional competency at work and professional behavior, right? That will damage the reputation. So you will get about 1 to 2 marks, right, for writing this one aspect. And then looking again, that's one issue that we find. The second issue that we find is the request from managing director. Now the request is to audit company, his own company's accounts. So now who is this finance, same person, financial controller, his spouse is going to audit, right? Or he is going to audit. So that is obviously self-review threat. So there is a self-review threat because he is responsible, or he oversee means, supervise financial reporting for the company, right? So there is a self review threat. So like that, you can easily write an answer. I mean, you can add another 1 or 2 sentences and get 5 marks. And one might say there may be a familiarity threat because the question use the word, he is a very close friend of this thing, this close, the examiner has given this word close relationship with a reason, right? Why this is given in the case study to say that, because when they are very close, even an unethical request from the managing director to mislead financial statement, this person may entertain. That will again tarnish the good reputation. When I say good reputation, what is the principle? Professional behavior. And then you might, not you, the person may cook the books. That is integrity, right? So now see how you can write another point based on the relationship. Now the close relationship, right? And the conflict of interest, because he is doing both work at a lower cost for the company. Conflict of interest, right, may result in unethical requests being entertained, right, which may damage or which may affect fundamental principle. Two principle: one is if you cook the books, that is integrity; other one is professional behavior, right? So those things, I mean, that's all. So you will easily get 5 marks, done. right? See, you can also get the answer. When you get the answer, you can look at the details. So going to the next question. So this we already read. This company wants to form an audit committee. You have to write what are the guidelines for audit committee and the benefits. So very easy answer. What you can simply say, you know, is audit committee. One is when you say guideline, right? Audit committee guideline means to say that, okay, how many members, who is the chairman? I mean, those are very basic questions. So audit committee should have at least 3 non-executive directors, right? And you have to say that at least 2 should be independent. I mean, those are basic things. And the chairman should be independent. So then you can simply write those points and get marks. That's very easy, right? Chairman should be independent. Now, what you may lose marks or you may not get marks is to explain why audit committee, the benefits, right? Now, these things you can't memorize, right? And you can't refer to the books and find these answers during the exam pressure. So, how to create, develop an answer in a creative way? Now, look at this. I'm only showing the circles which can be converted to an answer. Why there is audit committee? Number one benefit is it ensure the quality of financial reporting. Answer one. But you have to say how. Quality of financial reporting. How? Because one of the main role of audit committee is to review judgmental areas of financial statement, like Chamath discussed in the answer, say the credit, whether it is impaired, the revenue recognition. So audit committee will review especially areas like accounting estimates, fair valuation, and make sure financial statements are prepared in accordance with financial statements. So I wrote one answer for circle 1 and got 1 marks, right? The second circle is what then? Now, what ensure the reliability of financial statement? The second part is internal controls. Now, specifically when there is an audit committee with internal audit function, it makes sure, right, that the possibility for fraud and errors are reduced and the internal controls are stronger, because audit committee's second major task is to make sure risk management and, all right, in short form, risk management and internal controls are effective, and this will make sure, this will reduce possibility for frauds, right, with the help of internal audit. So this is a second circle which you can convert to an answer. And then if you look at the third one, so you can ask, okay, what is the third circle where you can write an answer? That is whether there is an internal when there is an internal control system, how do we know whether these internal controls are working properly? And that is auditors. So the other two circles represent internal auditors and external auditors. In an organization, when there is no audit committee, the internal auditor can be at risk because the directors can influence them. So you can write another two answers. When there is an audit committee can oversee, supervise internal audit function and ensure the independence of internal audit function, IAF, right? So similarly, the other important part, more than the internal auditor from public the accountability angle, is external auditor, right? Independence can be ensured, and their audit committee provide a frame of reference for external auditors to highlight any issues related to independence. Now see, we have written 4 points. If you want additionally to write something, now when there is audit committee, it is a good forum for finance director to highlight any issues. For example, there is no qualified accountant in the company, there is no proper ERP. So the finance director can put this proposal easily through the audit committee and get the things done. So that completes another 5 marks. You see how easy, but you will never write these answers if these pictures, this conceptual understanding is not there within you, right? So this is the trick for you to pass this paper. You must know. I'm telling you, don't understate this. Look at the past paper. There are some questions. This is a very basic question, but even a basic question. Now I can give you a new question, but I don't take much time. Right now, you are the CFO and you are supposed to draft audit committee charter for the company. How do you answer that question? Can you immediately use the open book? Do you know there is audit committee charter which is already there? The content of charter, you can easily look at the book and structure your answer. So that's how you can do it. So the next question is demonstrate how this is the part I said ideally there has to be a section in the question that explain integrated reporting in the absence. Let's see the meaning of this question. How company can create or diminish business model. Now, can anybody tell me what are you going to write to get 5 marks? This is a good question. If ideally there can be a case study and this can be converted to 10 or 15 marks question. Can anybody tell me what are you going to write? First of all, again, you can paint a picture what business model means. It is like a money-making machine. No business can make money. Look at I hope you can see my Word document. Uh, no business can make money. Now look at this. No business can make money. It's like a money-making machine. You see in the middle business model. No business can make money only by having money. You need to put brilliant people, the intellectual, you need to have best-in-class manufacturing facilities, the good relationship with the customer, society, and the environment. When you put all of these things together, what will happen is the input, right, through the business activities can convert to output. But output doesn't mean you are successful. That output is going to create outcome. For example, if you take a company manufacturing beverage, okay, beverage is there, but this is unhealthy. After sometimes people will not buy that, right? So therefore you need to think how outcome is going to create the value. Now, see, this is theory, no, but how to answer exam question now? Demonstrate how company create or diminish value using multi-capital approach. Now, in an answer like this, you need to definitely explain what multi-capital approach means. The answer point one to say multi-capital means we are talking about 6 type of capital holistically creating value, because no one capital can create value in today's context, especially in a sustainable manner, right? So how six types of capital create value? Then you need to explain what do you mean by creating value using the business model. The key to the answer is that the value creation, right, depends on the outcome. See, the key thing is this is the value. You can be very profitable, will stop your business, right? If you use child labor or use inferior products and give inferior products to customer, they will not buy you. Your reputation may be tarnished, right? And suppliers will not supply to you. So value creation depends on what? Outcome. Now let us take an example, right? Outcome of the output. Now what do you mean by that? Now, when you explain this, you need to take, for example, company can introduce a new product and claim a premium price. Now, let us say you ask for a good price, but it doesn't mean you are profitable, right? However, profitability depends on what? Your cost structure. So now cost structure depends on your other types of capital, how good you are in intellectual capital, the efficiency, what are the unique systems that are there to reduce the cost, right? Cost structure, supply chain. Now that is, you have to look at not only whether you can sell a product at a premium price, but are you competitive in terms of your cost structure. But remember, still you can make short-term money. Your next point is long-term value creation depends on some other intangible things. What are those? Can anybody tell me? Long-term value creation depends on what? Now see, you would have read, you can Google and ask what happens to Volkswagen, right? Billions of vehicles, they have fixed defeat devices. right, to cheat the energy, the emission testing, and that tarnishes the reputation of such a big brand. So long-term value creation depends on the relationship. Now that is where the relationship capital comes. The relationship the company creates, the environmentally friendly production, and so on. So long-term value creation depends on reputation, ethical businesses, right, customer satisfaction, things like that, right? So those will not only you can be profitable in the short run. If companies really focusing on these aspects, they can create long-term value. Now that is the answer. So how we develop the answer? Look at, have this into, now even with this knowledge, you go to the study text and read the study text, the integrated reporting platform. Remember, after the exam, when you become a CFO, can you actually prepare a set of integrated report for your company? So this thinking is extremely important, right? So for the answer, in summary, what you are saying, the multi-capital, when you put together, you can come up with an outcome, right, that will not only result in profitable business, but to sustain that business, the long-term value creation, you have to win other parties, like especially the society, retain your talents within the organization, create intellectual capital like patent right, things like that, and then give positive outcome to the society. So that completes another 5 marks. So that is how we got 15 marks, probably within 15 minutes, right? Giving more time for Chamas to work with you on the consolidation, I will quickly touch the other area which definitely connects to accounting standard from the perspective of risk of misstatement. So that is your section 2, question number 2. Right now, again, I am saying in the actual exam, you can now see these questions. Right now, the good student will not read the case study, but read the learning outcome and see, are you able to score very quickly 10-15 marks. Okay, evaluate fraud risk factors. Wow, one student who read this area and have a picture in your mind, there are 3 fraud risk factors, these 5 marks guarantee. Another student, of course, what is this? I have never read this, will ignore this. It's a very easy question. For those students who have read and understood and be able to apply one case study, give example. Now this is a popular question. If you look at past papers, this has been tested in many papers, and now with the syllabus change, there is a change in the syllabus learning outcome. There is emphasis on auditing aspect to identify risk of misstatement. So that is 4 marks. So altogether this carries 25 marks, and the syllabus weightage also 25 marks. You have to understand the importance of this section. Be very sharp in your answer. If you write stories, you will not score. And if you don't allocate adequate time, if you get stuck in consolidation for 2 hours and other accounting standard, this entire 40 marks will go. And that is probably very reason pass rate for this subject is lower. You can't in not only financial capital, right? You are balancing with social capital, relationship capital. So likewise, balance this way. So coming to this section, now we have to answer 3 fraud risk factors. So you should know these 3, right? What are the 3? I, can anybody tell me what IOP, that is 1. You can find something from the answer. The other one is O. The other one is A. So what are these? The fraud triangle. Can you find incentive or management under pressure to manipulate? Put down one answer. This right in this heading also you might get marks, because these are the fraud risk factors based on auditing standard number 240. And then are there opportunities? Right now, what do you mean by, again, no point of memorizing opportunities? You must know with a very simple example what opportunity means. For example, if company has weak control, or a chairman, CEO, the same person, that there is a dominance at board level that can give rise to management override of control, and that is a fraud risk. And this fraud risk is there in every company. You can easily write this answer. Third one is attitude. That is to say, you know, whether people are unethical, things like that. Based on the attitude, they will do the bad thing and say this is good thing. Now see, that's the answer. I mean, that is not the answer, but if you don't know this, you will not write a proper answer for this. And your answer has to be under one of these headings. And then 5 components of COSO, right? So you need to be able to explain very quickly to get out of this 10 marks, the 5 marks, right? The control environment, which is the foundation, and then how company identify risk, which results in misstatement in the financial statement, the risk management process. For example, okay, I will explain this as a part of the case study, but if you don't have this picture in your mind, you will not logically write an answer. So the control environment is the governance, whether company has good governance. One word, tone at the top. When there is good governance, do they have a process of identifying risk? Now, why risk management is important for accountants? Because now let us say this case study is a telco. Did you notice the telco revenue recognition is one word, complex? You use this word complex, you will get marks. Why? Auditing standard specifically says revised auditing standard 315 IRF factors, inherent risk factors. One of the factors is complexity in the revenue recognition. Like Chamath discussed in the question, you know, the bundling and unbundling, different performance obligation with the connection fee, the you know, timing, the phone call charges, and various elements you make. There may be judgment to exercise whether to separate revenue. The process of revenue recognition is complex. Now that is a business risk. Now you see, one part of your syllabus is to convert business risk to ROM. Now business risk is a risk which is inherent in the business. The ROM is how it is going to impact your assertion at the financial statement level. If there is a revenue leakage in telco, that is going to affect financial statement assertion like completeness and cutoff. Now that is how you should write an answer. So I explained to you COSO framework. The risk means that how business risk is going to affect your numbers. And then when numbers are going to be affected, company will have policies and procedures to make sure there are proper control. That's where control activities come. So what are the two words? Policies and procedures. What are the examples? Starting with SOD, segregation of duty, authorization, reconciliation, verification, all of these are control activities. So that will make sure if any risk is identified, there are policies and procedures to make sure those risk mitigations are carried out. That's the meaning of control activities. And then you need to have good information system and communication to make sure you get reliable financial reporting. And finally, somebody has to monitor whether these controls are working. That is usually internal audit. This is COSO framework in 3 minutes. Now you need to write an answer. In your answer, you will get about 5 marks for explaining this. I will show you an answer. Again, this is a good area if you straight. Now I have the auditing standard book with me, right? See, this book you will never read at the exam. But if you know there is an extra appendix 2 which explain these elements, and you can simply extract the most prominent relevant two sections and write. Even there you can copy paste. Why? Because here this question has two parts. One is you need to demonstrate the elements, right? But then don't write a very long paragraph, but you can extract the most relevant one. For example, to explain the control environment, if you write an answer with the word tone at the top, you will definitely get some mark. So the idea of control environment is AAA. What is AAA? Management action. The governance and management actions, awareness and attitude regarding controls, and the importance. Simply, board of directors think that we should have a good control. We should spend money to recruit a qualified accountant, to have a good system. That thinking is control environment. That's why we call tone at the top. So write it, you will get the marks. So now this one, I will show you the page references how you write the answer, right? So this you will get with the suggested answer. I hope you can see my slide. Word document that I'm sharing with you. The page references are given for each of these, but then there is another part of this question which requires you to relate this to the case study. So there you may, now I haven't even read the case study, but we are going to be very sure that we will score all these 25 marks. That is to know whether you know fundamentals before reading the question. Otherwise, you are just reading but not writing the answer properly. So the last question to get another 10 marks is to talk about 4 risk of ROM. Now, only thing, the picture you need to be there in your mind when you talk about ROM, right? Remember, it may relate to either inherent risk or a control risk, and the new standard specifically has given this two Coombs approach, right? And you will wonder what this means. When you find answers, remember this: if there is an inherent risk, right? Two C's. One is it may be due to complexity. Now, in this case study, we can relate revenue recognition for the complexity. Other C relates to change in the business model. For example, company has this year gone to digital mode or the e-commerce. That change can create a new risk. Two C's. Then U refers to uncertainty. For example, certain fair valuation of financial instrument that you learn can create a significant risk. And then the last one, the M is a very important M, management bias. So management bias is always there when it comes to accounting estimates, which will result in a fraud. Now, if you don't know these things, which means you are very weak in this area and you are not going to score 25 marks, right? So that is the warning that I am going to give you. Don't ignore this area, right? Now let's go to the case study and write answers. Now I have already given all the framework for all 25 marks. Let's see how to connect the information and build your answer. And then when you get the answer, even now I will show you the each point. But if I start writing now, I will take Thomas' time where he is going to give you a live experience of analyzing the consolidation, doing the consolidation. So getting to the question, now we know why we are reading. We are reading for two purposes. One is we need to identify 3 fraud risk factors. Immediately after identifying, this is my answer sketch. I have done a scratch. So I will write fraud 3. I may find all of these 3 or at least one of these 3 for part 1 of the answer. Part 2 of the answer, I have to find at least one information to talk about any one of the question. All 5 I have to tell something. Then only I will get 10 marks. If you read, if I go back, you see within bracket examiner says each component you should be able to connect to the at least one example from the case study, right? So the last question I explained to you using Tukum's approach. That is where you have to be mindful when you read the case study to see whether there are any of those factors, right? So now by looking at the case study, this is a telco case study. I will quickly run through. Now you know why we are reading this case study, right? As I identify the answer, I am marking, highlighting, and if you are writing now, just make some notes about writing, because like earlier question, I am not going to write. It's going to take more time. So connectivity PLC. So this PLC is a telco. Telco is by nature complex and regulated, right? So let me to highlight some of the important points. Highlighter doesn't come. Right. So when you read the question, the company's organized initially basic information. This first paragraph is pretty basic. The company structure, where they have two customer facing, that is a telephony and internet business and regulated business. That's first para, just information. The second para, with largest, now you have to carefully read to see, can I pick by reading this sentence any fraud risk or a ROM or a COSO related points. That's why you are reading. With a large number of licensed telecommunication providers in the country, the market has become extremely competitive. There have been a move towards rapid tariff reduction as both mobile and fixed line operators compete aggressively. The company sets targets. Now, up to now, you can easily identify one risk. So, what is the risk that you can identify now? Can you respond using the chat option? Yeah, what risk? So one of the risks that you identify is, now see, I had to categorize, did you find any incentive or pressure, right? Remember, when the industry is competitive, right, extremely competitive, and there is a price reduction, and that, look at the numbers, right? Now with this competition, probably the companies, while they have increase marginally their revenue, some increase, you can see with the price pressure, the profitability has been affected. Even if you work out ratio, but don't waste time by doing a lot of ratio analysis, you will not get any marks. If there is a question specifically on analytical procedure, you can write. So you have to be very sharp to answer what examiner requires. Sometimes you would have spent a lot of time on analyzing these numbers, not necessarily required. So one answer that you will write here is that the intense competition, right? And also you can talk about the price pressure. All of this create the pressure for the management. If they are not achieving target, they might mislead numbers, specifically revenue recognition. You can easily take that position because there is a presumption in fraud standard that every company, there's a rebuttable presumption there can be a risk of fraud. The revenue may have been overstated, because there is a pressure is created through the industry competition. That's one point you can write. The second point is, significant part of the operational and senior management reputation is aligned to revenue targets. In addition, profit related bonus represent a significant part of executive and senior managers remuneration. So another answer, this is what, why we covered pressure. Now we can cover incentive. Incentive means there is a reason to manipulate. The reason is that top management remuneration is linked to profit. So therefore, there is an incentive for them to misstate, especially those areas that involve subjective assumption and judgment, like accounting estimates and fair value. In this company, you can see there are discussion about impairment, right? And fair valuation, things like that. In those areas, they may misstate. See, the other area that you can write is a general fraud risk in many company. In this company also you can find whether there are information about management override of control. So really moving on, so to see these answers you can easily write under part 1 of the answer. Given the similar technology used by the competitors, differentiation is a integral part of the game. The company has embarked on an aggressive network expansion plan to stay ahead with the competition. Now see, that's the company's plan, right? Aggressive network expansion. Now can it result in a ROM? I am just asking, can you use that information to write answer to part 3 for ROM? If you are smart enough, if you know, if you have read this particular chapter in your study text called ROM, risk of misstatement, you know the risk of misstatement is based on auditor's understanding. What are you going to understand? One is industry. The industry is telco. Other one is you will understand internal controls, right? Then you will understand accounting policies. Some accounting policy based on the complexity, for example, revenue recognition, you will identify as a risk. The next area that you have to understand is business objectives and strategies. Now here, one of the business objective is aggressive expansion. Now you have to think from accounting language. Expansion can create ROM. Can you tell me what? Now go to the balance sheet and see, can there be a ROM based on this expansion, right? Now when you look at the balance sheet, you can see that there is a network infrastructure, and perhaps there are notes given, right? Now there may be item called capital work in progress. We have to read all the notes and see. But what I am saying, even though there is no notes, right, in the account specifically mentioning, but the case study says company has started aggressive expansion. So that expansion can create PPE recognition issues, right? For example, whether to charge certain capital loan, whether to capitalize borrowing cost, right? Borrowing cost capitalization. Now, these are the areas if there is a possibility company may not be able to properly do this. As a result, there can be a ROM. Remember, when you write a ROM, you need to say what assertion it is going to affect. Now, what I discuss under this heading is now see I am explaining to you the risk assessment part, right? These areas of understanding, right? I mentioned to you industry related risk, internal control risk, accounting policy related risk, business objective. One of the business objectives is expansion. Now we are connecting that to PPE valuation assertion. How to write the answer? If you are writing, I will show you the answer now so that you will be clear the point that I am mentioning. Then you can easily see if you are writing answer how you have to write the answer, right? That's very important. Now see, this is answer, very 2-3 sentence. Expansion strategy may result in significant investment in PPE, accounting issues such as capitalization, capital work in progress, capitalization of borrowing costs may be relevant, right? And there is a possibility of misstatement if this is not properly done. So it's always good to say the assertion is PPE valuation, right? So moving on to the case study. Now we read this part. Yeah, so we were reading last paragraph. Then it talks about given the complexity of revenue recognition. That's the point. You see the word complexity here. The accounting policy I mentioned to you earlier, TUCUMS, 2Cs, complexity of revenue recognition. Definitely revenue recognition is one answer that you will write. There are gaps in revenue. Internal audit division works closely with revenue assurance team and report to the audit committee, right? So what does it means? That if you are a sharp student, you must note here there is one answer. Remember, in this answer you have to explain control environment, COSO framework. Now the fact that company has an internal audit division that reports to audit committee indicate that the management attitude, awareness and action triple A is good regarding control environment. Now see, case study requires you to give one example when you write answer to the COSO framework. What is the example? Now I will again show you the written answer so that you will know exam writing standard, right? Now see the suggested answer. The control, and I can write now the answer because it takes time. I am showing with references. The control environment. Now you can write this answer differently, but when you write this answer, remember easiest way is triple A, tone at the top. So remember those words and write answer in your word, tone at the top, right? What is triple A? The governance and management attitude, awareness and action regarding the internal controls and their importance. And now in the case study, what limited information is there about the control environment. However, company has an audit committee with internal audit function. It is also stated that internal auditor reports to the audit committee. This indicates the independence of internal audit function, right? So this is a good indicator about the management attitude regarding controls. That is the answer, right? So that is how you have to write down. See the marks, how marks are allocated. 1 marks for giving this theoretical explanation and another marks for giving case study application. That's the marks allocation. It's not easy unless you are properly structured to give this answer, right? So then the last bit, revenue recorded in the billing system. Now they are talking about revenue recognition. Revenue recorded in the billing system is transferred to general ledger, GL. Now what is being explained here is the financial reporting process. Having multiple systems. One is a billing system. From there, the information is transferred to GL through an interface. If interface fails, an exception report is generated, which is reviewed by the accountant. Now this tells you another part of COSO framework. What is that? Control activities. So I told you earlier. Now see, I have already written all the points in this little box. Let's see where are the control activities. I said control activities are policies and procedures that help management to carry out what? The risk mitigation. Any risk identified here, one risk is revenue. So how do they handle the revenue recognition? Now first of all, we can write one answer, revenue as a risk. Now under ROM, I told you there is a framework called 2Cs. If now revenue recognition in telco is complex, why it is complex? Use the case study and explain. Because revenue involve billions of transactions, large volume of transaction in telco. One reason for complexity. Second reason is processed through multiple systems. Right? As a result, there is a possibility that some revenue may not be properly recorded. The second reason, if I apply accounting standards, again, you need to carefully see possibility of can there be, reasons where you need to split revenue into different segments, elements, right? So likewise, you can easily write one answer for ROM based on the revenue. Let me to show you that answer. The revenue recognition, I am going to the ROM section. If you're writing an answer, see, the same answer I explained, the word complex is very important, and don't just write complex and don't think you will get the marks. Why it is complex? One is there are estimates, the large volume of transaction which are processed through multiple information systems. And then the possible accounting issues, the need to record revenue, for example, connection fee, call charges to be recorded separately, right? So these requirements may create complexity. Now I am writing one answer here. Another answer I can go to now COSO framework. Now you see, this is the beauty in the COSO framework. We already discussed control environment. That's the tone at the top. The second element of COSO is risk management. Now, this company identify revenue as a risk, complexity as a risk. Now, how that complexity is addressed through control activities that they have a reconciliation from billing system to GL, and that is monitored through an exception report. That reconciliation is a control which is monitored. That example you can write under COSO answer. I will show you that answer as well. If you go to the COSO framework, see the control activity, you are giving some theory explanation. You can take this from the book. But I explained to you, if you are a logical student, you will only remember few words. I will highlight those words that I mentioned to you. Policies and procedures that are there to ensure management directives to mitigate the risks. Risk mitigations are actually carried out, right? And I told you that's about the authorization, segregation of duties, verification, reconciliation, etc. So from the case study, pick one example. This case explains the importance of certain control. For write that and get the marks. So now we covered, read the full case study, the full answer sentence. Revenue is one ROM, and you are the audit senior allocated to the audit of connectivity. Following information has been presented to you. Now we may have to read some of the notes. Revenue, we discussed revenue recognition as a risk, and now you can do a basic analysis and see. You don't spend time on ratio analysis before reading this information. At the end, you will already know the full answer. So why waste time by analyzing all the ratios? Because you have to write what examiner wants. If examiner's analytical review, you can use ratio analysis, right? So now read the notes. The revenue recognition part we covered, right? So all this is to suggest that there are different elements. Then impairment. Now they say impairment consists of this network coming to various generation of new technology, and then impairment is done using the value in use approach. How cash flows are generated based on the approved budget covering 5 years. Cash flows beyond the 5 years are based on the extrapolate using the estimated growth. The growth rate does not exceed the long-term growth. I mean, this looks like a proper impairment. But there are some case study. They say that they use, they even take some incremental cash flow to the impairment cash flow. Those are not acceptable. They just use some growth rate which is not relevant to industry. But this information looks proper. But still you can write an answer under PP impairment. Why? Remember Tukums. You will wonder what Tukums means. The complexity, right? I mentioned to you the word complexity. Now remember, when it comes to things like impairment, there is a subjectivity, subjective judgment, there are professional judgment that involves. So the simple answer that you will write, So because this is telco, there is a significant property, plant and equipment, and because of the technology change, there is impairment. So the risk is because impairment involved. Now these are my keywords. The paper marker will look at whether you answer this word: subjective assumption and judgment. Because of the subjective assumptions and judgments, right, there is a possibility of overstatement. And connect this to the fraud answer. As mentioned above, there is a management bias. As a result, the impairment may be inadequate. That's the answer you will write. Done. So we got now one answer revenue, second answer impairment, third answer is PP valuation. And now we already got three. We have to write only one answer. That is brand. So brand is what? Brand. Remember LKS 38, brand recognition. Brands that have been developed by the company are recorded at fair value at each balance sheet date. Assumptions are used in estimating the value, such as intangible assets, and include management estimates of revenue and profit. Now, can somebody tell me the brand recognition? Can there be any risk? Brand. So, what are the accounting treatment of a brand? Can the brand be recognized as an intangible? What are your answers? You have to see this is the connectivity between accounting standard and auditing. Remember, you can in business acquisition you may acquire a brand, but if it is an internally generated brand, LKS 38 explicitly prohibits recognition of certain items like customer lists, brands, etc. So then you can easily write a risk to say that this looks like an internally generated brand, right, and developed by the company, and then the LKS 38 prohibits recognition. As a result, asset may be overstated. The other easy issue is depreciation. So that is a very easy one, because you see they depreciate using all the assets using the 40 years period. But when you look at the replacement life cycle, these assets contain different life as per standard LK 16. Each significant components need to be depreciated using their effective lifetime, using the component depreciation. As a result, the pre-P may be misstated. So that answer also you can write. Now see, you can easily write the answer. And the last part is just about intangible asset. Again, if you are writing an answer, you can write the basic answer, risk of overstatement. But by now we have written more than 4 answers. So now I will show you. I can conclude now and hand over to Jamaat. But I want to show you how the answer looks like. See, the answers that I explained to you so far has been well documented. Fraud risk factors, the intense competition create the pressure. You can look at connect by numbers. The profit has reduced by 69%. This may be due to the competitive pressure. And then remuneration related point. Third one is a common answer for any case study. There is a risk of management or of control in every company, but this company may be higher. And then we discuss the course of framework 5. One is to give explanation, control environment. We discuss risk assessment. Now specific information in the case study. Therefore, you will write a general answer to say that what risk assessment means. It's a process to identify and analyze risk. But in financial reporting, we need to see the connectivity between business risk and the risk of material misstatement. And then say that in this company, there are many examples like revenue recognition, which are business risk like technology change, impairment, right? So those you can write. And then, yeah, this we have written here. You can see in the answer. The business risk like the competition, how it creates fraud risk, how technology change can create impairment risk, things like that. And then control activities I explained to you. The information processing also we covered. The case study specifically talks about information processing, how billing system transfer to GL and the exception report in all of that. And in addition, journal entry also important. Monitoring is about internal audit. That is also there in the case study. You can write and get the marks. Now you can genuinely ask, while you can spend a lot of time on other questions, if you did this pilot paper, if you benchmark, you answer with this answer, out of those 40, what is the marks that you can actually score? That question I am leaving for you. And with that, I conclude my section. And over to you, Chamath, to carry out the rest of the interesting part on consolidation.
Thank you very much, sir.
Thank you very much.
Okay, student, and thank you very much, Suranga sir, for bringing your expertise, which will help you to student to understand the risk of material misstatement part very well and answer the questions in an effective way during the examination. So actually, student, as Indonesia said, risk of material misstatement, this 40, let's say 40 to 45%, we cannot ignore that part as well, especially when you are going to answer this particular paper, advanced business reporting. So too much focus on accounting standard will not bring you anything, and too much focus on risk of material misstatement also will not bring anything. So what you have to have is balance between these two, because risk of material misstatement part also equally important. Even though I am a lecturer who are doing the financial reporting, but I will always telling to you that risk of material misstatement also having equal importance, because most of the time students are forgetting some part and they will go ahead. That is why most of the time you will end up with 48 or 47 marks, something like that. So don't take it easy. So focus on all those things. And the consolidation question, as Indonesia said, consolidation question. So what do you think about the question, students? So easy or difficult? So can you give your opinions on the consolidation question? What do you think about? Difficult, easy? So anyone, any suggestions? You can just type what you think about the consolidation question. No one is going to reply. It's moderate. Difficult, or Nekmal is saying difficult, right? So obviously, student, it should be difficult because we are at the strategic level and the question should be difficult. If the question is easy, I don't believe we are not at the strategic level. So soon after this particular paper, and this particular paper, ABR is the core subject behind this chartered accountancy profession. So if you are immediately after this particular paper, if you go, let's say you are going to a firm or a company and you are going to prepare the consolidation, there are a lot of complication comes in students. So that is why you need to learn the difficult scenarios. And there are some common mistakes that you will do when it comes to this consolidation question. That is why most of the time students are telling the consolidation question is difficult. So I will tell you a few examples, student. The first thing is, when it comes to consolidation question, I will tell you some guidelines. Don't focus on finishing the consolidation question. Don't focus on finishing the consolidation question. First, your focus should be the goodwill computation. Because if you have taken whatever the past papers, there are very few instances that examiner is asking to complete the question, but every time they are worrying about the goodwill computation. Even if there is a question in consolidation, goodwill computation carries significant amount of marks. So focus on the goodwill computation. If you have more time, then proceed with the other things. So basically, student, what is I'm telling, goodwill computation, even though it's an acquisition, even though it's a disposal, whatever, yes, Suranga sir, thank you very much, sir. So Suranga sir is leaving, thank you. Anyway, whatever the situation, so do you want to have a last word with someone?
No, just want to wish you. So I'm sure you will do a great job in completing. So kindly excuse me. All the best for all of you for the exams. Thanks, Chamath. Please
Thank you,
continue.
sir. Thank you for. Okay, student, let's move on. So basically, student, don't do this mistake. And one thing is, so don't focus about completing the question. Just focus about the goodwill computation, because whatever the acquisition or further acquisition or disposal, that computation, goodwill computation matters a lot. So focus on that. Then focus on other areas. The other thing is, most of the time I have seen students are having a lot more focus on basic consolidation aspects, unrealized profit adjustments, brand amortization. So those things are very rarely tested in this particular paper. So you have to have good focus about complex consolidation. Anyway, the basic consolidations are, that knowledge is very much important to approach the consolidation question, complex consolidation. But what is tested actually is the complex consolidation. If you have closely look at the past papers, The changes in group structure is the main thing that they are testing for this complex consolidation scenario. So far, foreign subsidiary not tested, and recent past, they have tested, more or less, they have tested lot of instances from acquisitions and further acquisitions. But here, student, this time when we look at the pre-scene and all those things, I also can give you some comments, and I also can guess, and I can tell you there's a high possibility that some kind of a disposal scenario will be tested this time. So anyway, this question is a really good question. Anyway, this question carries a disposal as well. That is why this question I have to pay, and you have to pay more attention on this particular question. So with that, student, we will go to the question. I am sharing the screen. Anyway, this question is developed based on without a pre-scene, but it is not happening when it's come to the examination point of view. So you have the pre-scene and you have to read the pre-scene. This time you have 22-page very lengthy pre-scene. So you have to read it very carefully and you have to guess what are the areas coming to the exam. Even though, so I have seen sometimes you are coming to pre-conclusions, so don't come to pre-conclusions. Don't. Now I also told that there's high possibility that disposal will come, but don't get stuck to that. There's only a possibility. There may be some other things also can be tested. So most you can guess, but you have to get ready with everything. But based on the examination, I would say the pre-scene, you can get some of the questions or some of the actually the consolidation question. This time, what kind of a question is going to be asked? Right. So this student, this particular example also student developed without the pre-scene, but this is having that much of some kind of a gravity which is required for this strategic level student. So basically, student, just to go through with the question, we will just read the question quickly and we will come to the discussion later. Right. So hope you can see the screen. So Bill Green, BGL, carries on business on distribute of construction equipment, import and distribution of fruit across the country. BGL was incorporated in 2018 to distribute construction equipment, and part of their diversification strategy. 2019, company expanded its operations by acquisition of shares in Red Apple Limited. So the parent company is BGL. They are acquiring Red Apple Limited in 2019. And Mango Private Limited, MPL. They are acquiring two subsidiaries, RAL and MPL, right? RAL means the activities to import and distribute food from foreign countries, where MPL distribute fruits collected from local farmers in Dabul area. Perfectly okay. So we will go ahead with the Red Apple Limited. On 1st April 2019, this is the acquisition date of acquisition, very important. BGL has initially invested 101 million. This is the purchase consideration in terms of cash to acquire 800,000 ordinary shares. 800,000 ordinary shares. So here you can see, student, they have given a summary for the equity basis of RAL, Red Apple Limited. So RAL, basically, you can see stated capital 120 million. 1 million ordinary shares. They have the quantity of ordinary shares 1 million. Out of 1 million, you are acquiring 800,000. It means, student, 80% you are acquiring. So RAL, in terms of RAL, the acquisition percentage is 80%, right? Ordinary shares of RAL, they have borrowed from a financial institute to source the amount required by the cash payment, right? Further, they agree to issue one ordinary share of BGL for every 10 shares acquired. So what they are agreeing, this is actually a share consideration paid in terms of share consideration pays purchase consideration paid in terms of shares. So what they are agreeing, they are acquiring 800,000 shares for one share, issue one ordinary shares for every 10 shares acquired. So if you acquire 10 shares, you will give one share. It means 800,000 shares, you will give 8,000 shares. You will get 8,000 shares of parent BGL. Then what you require to do, if you have a share consideration, that share consideration as per SLFRS 3, that share consideration should be taken to purchase consideration by considering the fair value of that particular share as of the acquisition date. Fair value of the particular share as of the acquisition date. So if you go here and look at the student, The fair value of the shares of BGL and RAL were estimated 100 and 125. This is the BGL and this is the RAL. Which share price you have to take? The BGL share price you have to take. Why? They are the one who are issuing shares. They are the one who are issuing shares. So 8,000 into 100, that is the share consideration you need to consider. Right. So here, student, further they have transferred the land which had carrying amount of 10 million. Fair value of 2 million. They are transferring a land which has a carrying value of 10 million and a fair value of 12 million. So you know, if it is a land consideration being paid in terms of non-current asset, you have to take the fair value and not the carrying amount. Further, BGL agreed to pay another 10 million in 3 years if RAL achieve revenue growth of 15% compared to the current financial year. What is this, student? This is a contingent consideration. Contingent consideration. When it's come to contingent consideration, student, you have to consider two factors. The first one, you have to capture the probability of that event happening as well as the time value of money. So this particular, here we have what is the amount, 10 million. You have to capture the probability of happening. The probability of happening is 40 million, 40%. And what is the time value of money? It is 3 years. So you have to decide the discounting factor. So if you go to the down of the question, additional information, they are giving the discounting factor of 10%. So you have to use the discounting factor and you have to discount it as well. Right. Then it is done. Legal fee associated with the acquisition is 1 million. So legal fees, can we take the legal fees? Transaction cost? No, it is not a part of the purchase consideration. It is included in the initial cash payment of 101 million. So this 101 million, this 1 million included, you have to remove it. You have to remove it. So that is what they are. Okay. So here then we have the equity basis. This is the date of acquisition. Date of acquisition. So what is happening, student? Basically, we will read first. And then we will come to the question. Right. On acquisition of 1st April 2019, fair value for land held by RAL was provisionally valued and valuation report received in 21st April 2019. So what is the date of acquisition? This is the date of acquisition. So after a few days of the date of acquisition, so this is the date you have computed the goodwill. After you computed the goodwill, on a later date, you have received some information regarding the provisionally valued what land price or whatever you are receiving. So what is this, student? This is what we call measurement period adjustment. Measurement period adjustment. So as per the measurement period adjustment, student, what you can do basically at the date of acquisition, within 1 year's time, within 12 months period of time, whatever the situations like this, whatever the provincially valued valuation, so anything happening to the goodwill computation, you can reverse. Actually, I would say whatever the things happening after, whatever the things means goodwill computation, whatever the things related to goodwill computation, if there's any change within 12 months period of time, that change you can incorporate into goodwill computation. That change you can incorporate into goodwill computation. Right, that is what we call measurement period adjustment. So even though this particular report we received immediately after the date, not immediately after, some days after the date of acquisition, this particular adjustment you have to consider for goodwill computation. Goodwill computation. If you can't remember the measurement period adjustment, go to the study text, go to the accounting standard and read it. So it is very important. Then, student, moving forward, Mango Private Limited, on 31st December 2019, BGL has acquired 55% of its stake. So BGL, the other arm is the Mango Private Limited, NPL. You are acquiring 55% of the stake, where another party known Fast Track Limited. Okay, there's NPL, another party called Fast Track Limited is remaining 45% interest. What is happening? In this BGL, you are acquiring 55%, but another party is having 45%. Both of the parties have agreed decision making regarding the new entity will be unanimous. Very important word. So student, tell me, for BGL, what you can say, what is the NPL? For BGL, what is the NPL? Joint arrangement, not joint arrangement actually, so it's a joint venture. Joint arrangement as per SLFRS 11, joint arrangement has two parts, joint operations and joint ventures. So what is the basic difference? Joint operation, just sharing of assets. Joint venture, you have a separate entity with net assets. So here also we have a separate entity with net assets. It's a joint venture, and this unanimous, it's a unanimous decision taking goes. Either party has direct right to assets and direct obligation liabilities entity. Instead, they will have interest of net assets. It means it is not all about sharing assets and liabilities. That's what it's mentioned here. They are having the interest of net asset. Net asset means if there is a separate entity with the net asset, it is a joint venture. So MPL is a joint venture for BGL. Even though the 50% of shareholding, that doesn't matter. So joint venture doesn't require to have the 50-50 shareholding. It's a myth, student. It can be a 55% shareholding, but if you have a unanimous agreement, that is coming under joint venture. Why? Unanimous agreement means, yeah, other party doesn't want to proceed with any decisions, you can't do it. You can't do it. Even though you have 55% majority voting right, you need to get the consent of other party to proceed with any decision. So here, student, BGL has invested 27.5 million cash to acquire NPL. So basically that is the purchase consideration. They have borrowed from financial institutions, so the amount required from cash payment at the date of acquisition. The following table summarizes the equity basis of NPL. So 3 days is the date of acquisition. So 3 days they are given. We will see further. After the period of 2 years, no acquisition or proposals. In November 2021, corporate finance teams of BGL has come up with 2 proposals to overcome the challenges faced by the company due to COVID-19 pandemic. Right. Proposal 1, we read. Due to the financial difficulties faced by COVID-19 pandemic, the imposition of import restrictions for imported fruits, BGL will announce that they have no further intention to carry operation of RAL. They are going to dispose the student, they are going to dispose the subsidiary, and they will sell 70% of interest of RGH to Settle Blue Limited. So they have 80%. What will happen? They will sell 70%, and now it's becoming 10%. Just an financial investment, just an financial investment. There are a lot of scenarios when it comes to disposal, student. So disposal can be done without losing the control. Let's say 80% shareholding, you sell 20%. 60%. Still you have the control. We call it control to control situation without loss of control. So what we can do is we can sell a subsidiary, some portion of the subsidiary, and we can become a associate. Let's say 80% shareholding, we sell 50%, now 30% associate, investment in associate. That also where. Now here, what has happened basically in this particular circumstance, basically they are having loss of control situation, but they are not fully selling their shares. By keeping 10%, the 70% they are sharing. They are disposing. They are disposing. On 31st December 2021. So this is the disposal date. So if you go to this table, you can say they have given a net asset as of the disposal date. Net asset as of the disposal date. Right. To acquire 70% of SBL will be required to pay 70% of to acquire the 70% SBL, the acquiring company need to pay 125 million. So this disposal proceed or the selling price is 125 million in cash immediately. The fair value of the remaining interest 10% as at 31st December was 20 million. So you have keeping the 10% shareholding. The fair value of that shareholding is 20 million. Fair value of the shareholding is 20 million. It is important for disposal computation. Right. Moving forward, student. Already in November 21, BGL has shown interest to purchasing majority stocks in MPL. What they are going to have? They are going to have acquisition now. To get the controlling power. At the moment, you have joint control. Only they have a joint controlling power, but they are going to have the controlling power. They want to make it a subsidiary. Controlling power, since they have identified some market potentials expand in the both local and foreign context. This transaction also expected to be occurred in 31st December 2021. So the further acquisition date also 31st December 2021. So you can see here, this is the further acquisition date, and they have given after that, this is the reporting date. They are giving the information as well. Right. Which increased BGL's holding to 80%. 80%. So what is happening? Initially, they had 55%. They are going to acquire another 25%, and now it is 80%. BGA will controlling power as well. On the date, the fair value of 55% already held is 35 million. So they had 55% shareholding, the fair value is 35 million. Further 25 million to pay in cash. To acquire this 25%, they have paid 25 million in cash. So what they're asking, BGL group policies to measure NCI at proportionate net asset basis. Basically, we have two methods, fair value basis and the proportionate share basis. Right, here we have the fair value, not fair value basis. We have the partial goodwill method, not full goodwill method, partial goodwill method, NCI method. So discount rate we have captured. Prepare a brief note to the board of directors. BGL includes an analysis of the financial reporting implication of the transaction given above. Consolidate finance statement BL in accordance with applicable accounting standard 31st March 2022. Right, student. So student, most of the time when it comes to this consolidation question, when the examiner says prepare a brief note, students are asking, are we required to write everything? So let's say when it comes to purchase consideration, are we required to write in words purchase consideration, the cash consideration should be taken into account? Are you required to write it? No. So normally student, within this limited time, you have to write the answer and you have to score. There's two extensions. First extension is, what you can do is you can write everything that you do. You can describe the computations that you do under the consolidation question. Other end, what you can do, you are just preparing the question and you don't write anything. Don't do it as well. So you have to have some kind of a middle part. So you have to write something and you have to compute it. So don't go and write everything. Let's say purchase consideration, not required to write. But there are some decision points in the question, student. Decision points. Let's say here the contingent consideration, it is a decision point. So you may write, when it comes to consolidate contingent consideration, as per SLFRS 3, we have to take into account considering the probability as well as time value of money. That you can write. That you can write. Even if it is in your word, if it as far as it is giving the meaning of the standard, that is perfectly okay. Then when it comes to, let's say this measurement period adjustment, you have to write it as per the measurement period adjustment within 12 months. Whatever the changes to goodwill, you can incorporate. That thing you have to write, student. That thing you have to write. So here, unanimous. When there is a unanimous decision taking and no with net asset sharing, that MPL should be considered as a joint venture as per SLFRS 11. You have to write it. Always try to write the standard name as well. SLF, not the name, standard number as well, SLFRS 11, SLFRS 6, because then it will give more, it will demonstrate that you know the accounting standard. As far as that you are demonstrating that you know the accounting standard, you can score more marks during the examination, student. Anyway, it is not required to write the sections as per para this, but it is not required to write, but at least try to keep remember the accounting standard name and try to add that name in the question, because it is adding a real value to your answer. Real value to your answer. It shows your maturity. It shows your ability to demonstrate the accounting standard. That is very much important, student. So here, what are the other decision points? What are the other decision points? So here, what is happening? Maybe the disposal might be a decision point, right? But you can write all decision points. What is required? Not all, but selective basis. You can write the decision point. So here, student, with that understanding, I will go to the Excel because I am using Excel to do the computations. Hope everyone can see the Excel. Can you all see the Excel, students? Is it visible? Yes, thank you, Ravi. Thank you, Navala. Right, here, student, I have prepared the group structure. This need to be done in the examination as well. So most of you are approaching the question because you don't know how to approach the consolidation. Because you know consolidation, that I can assure, because you have followed the study pack questions, you have followed the revision kit, you have followed the study webinar, and you have participated from some classes as well. So you know the consolidation, that for sure I can tell you, I know that. But the problem is you don't know how to approach this question step by step. So that is very much required. So before answering the question, student, prepare a graph like this, prepare the group structure like this. So you can see in the screen, the group structure. This is the group structure that I have prepared. So take a piece of paper, even in the question paper, you prepare and nothing happening. So you have to do it. So do this first. then only the clear picture goes to your mind what should be done. Then part by part, you have to approach the question. Part by part, approach the question. So what is happening is, most of the time, I will take a simple example. You are going to a Chinese restaurant and that waiter, or you are ordering a roasted chicken. Then what is happening? If you are going to eat the entire roasted chicken at once, can you eat? No, student. So what is the best thing is, part by part you have to eat. Part by part you have to eat. The same thing applicable to this. Same thing applicable to this. So what you have to do is, student, basically, sorry for remembering the roasted chicken, even this late night, right? Sorry for that. But anyway, student, what is required here in this particular question, what my example says, part by part we will complete, part by part. So we will go part by part and we will move forward, right? So here, student, you can see the BGL 80% acquiring RAL, right? You can see, and it is 1st April 2019, and they are acquiring 55% of NPL on 1st December 2019. And what is happening later? RAL sale has 70% at selling price of 120 million. 10% of the remaining interest is valued at 20 million. And that is happening on 31st December 2021. And what is happening here, NPL side, they are acquiring remaining 25%, basically FTL selling, they are 25% to NPL, and NPL acquiring 25%, and it becomes a subsidiary on 31st December 2021. Purchase consideration as of this date 25 million. The remaining 55% fair value is 35 million. 35 million, right? Okay, student, we will move forward. So next thing is group structure, and group structure you need to do. Then what you need to do first? So here I can segregate this question into 4 parts, student. 4 parts. I told you the chicken theory, right? In that case, we have to roasted chicken theory as per part by part. So you can segregate this into part by part. The first part, BGL acquiring RAL. Do it first and think about the others. Do it first and think about the other things, right? So BGL acquiring RAL. The second part, BGL acquiring MPL. The second part. Third part, RAL. BGL is selling the RAL. Third part. And the final part, MPL. BGL is acquiring for the 25% of NPL. 4 part is, student, 4 part. Same way that what I am telling you to divide these things, it is easy to approach as well as same way marks also allocated on that basis. Mark also allocated on that basis. So that you need to focus. I am not focusing on completing the consolidation question, statement of financial position. Anyway, this is not required in this question as well, but focus on these adjustments. So go to goodwill adjustments and one further adjustment. One further acquisitions and one disposal adjustment. 4 things we'll do and it is completed, right? Oh yes, student. Then the most important thing, acquisition information. Acquisition information, that also very much important. In the paper itself, you, before answering the question, you have to have this kind of a summary. You have to have this kind of a summary. So I will start with BGL, student. So BGL, so the purchase consideration I have showed here. Fair value of net asset I have showed here. So first I will deal with the purchase consideration. Cash consideration is 101 million. 101 million. Students, I am going a bit fast because almost we have 10:20. So I am going a bit fast. So try to concentrate on this specific example, right? You can understand. So that is required from you. Do concentrate on this particular question. Cash 101 million. Cash 101 million. Then shares. What is happening? Shares. Every 10 share, we issue 1 share. Every 10 share, we issue 1 share. So what is happening? I have did that computation as well. So we are acquiring 800,000 shares. Every 10 shares, we are getting 1 share. We are getting 1 share and multiplied by the share price of BGL parent. Don't forget it. And the share consideration is 8 billion. Share consideration is 8 billion. Land, what you can do? Land, obviously, 12 million is the fair value, carrying amount is 10 million. You have to take the 12 million, student, not the carrying amount, because purchase consideration should be measured at fair value, right? Then contingent consideration, what they agree, pay 10 million in 3 years time, and pay 10 million 3 years time, And what is happening basically, 40% probability of pay. So what probability to pay? So 10 million into 40% probability, student, into discounting factor 1 divided by 1.1 over 3. This is the contingent consideration done. So I think it's clear. 10 million into 40%, I have adjusted the probability as well as the time value of money. I have taken the contingent consideration. Then what is happening, student? Legal fee. Can you include in the legal fee? There's a 1 million legal fee which is included in the cash consideration. No. What you can do is you can deduct. If you want, you can show it in here as well by deducting this, but I have taken it as a separate adjustment. So the problem is, student, how you are going to show this in the consolidation week. So there are a lot of methods that we can use, student, but I am using the schedule method just because of few reasons. Because schedule method is the method that we are doing practically in our day-to-day business operation. So that is why I'm using schedule method. But anyway, if you are using T account, that's also fine. The same concept is going on. But this is the method that I have used, and normally business, this is the method we are using. Because normally in business we use whatever the Excel schedules for consolidation most of the time. All right. Then student, we'll come to here. Cash. So what I'm going to do is goodwill of RAL and NCI of RAL. Goodwill of RAL, NCI of RAL. So this goodwill account, if you are doing T account, this is the cost of control account, thing like that. So cash consideration, you are going to show it here, right? And shares also you are going to show it here, link it. Land, you are going to show it here, but land you have another adjustment, student, because what is happening? Land, you are taking 10 million, you are getting 10 million land for 12 million. You are giving 10 million worth of land for 12 million. It means the carrying amount of 10 million and 12 million, you are having some kind of a revaluation, and that should be reflected in this group revaluation reserve. Or you can show it under group retained earning. That is also fine. Right? So anyway, because I have segregated here revaluation row, retained earning, but normally in a question that may be not required, but for the further clarity purpose, I have done it. In a question, examination question, maybe you will end up with group retained earning. And anyway, this entry is not required. Why? They don't want to complete the group retained earning balance. They don't want to complete the group revaluation reserve balance. They only wanted to know the goodwill and those things. So even NCI balance is also not important, student. But anyway, we will do this for our understanding purpose. Right. Then contingent consideration also you can show here. Legal fee also you can show here. So you can get the purchase consideration. And here, student, this contingent consideration, you have to do some kind of a subsequent adjustment. When it comes to contingent consideration, this probability might be changed when it comes to the reporting date. You have to capture it. Or there's an unwinding of interest as well. There's a time value of money, unwinding of interest as well. There's a question as well from Tahil. So do we need to unwind the interest? Yes. But here, I am not going to do that because there is no clue regarding the subsequent measurement of the contingent consideration. But if you want, you can unwind. Let's say when it comes to reporting date, let's say only 1 year passed from the date of acquisition. This is multiplied by 10% minus unwinding interest. That's how you can show. So what is the double entry goes, student? Contingent consideration credit and group retained earning debit. So that can be done, but here it is not mentioned, and group retaining is not required. I am not bothered about that. I will go for that. Legal fees, that is done. Now, student, we have the fair value of net asset other side. So if you go to the question paper, you can see 112 million stated capitals there, return earning 10, revaluation 10, and 140 in total. Someone has switched on the mic, I guess. Can you please? Right. Thank you. So 140. Sorry for that. So here, student, you can see stated capital, retained earning, and the total is 140. I have taken as it is. But there is a measurement period adjustment of 5 million. Measurement period adjustment of 5 million. So what you do is you adjust that measurement period adjustment, which is amounting to 5 million. There's a fair value gain coming from the land and building. So you have to adjust it. When there is a fair value gain, student, what is coming in? You have a deferred tax impact is coming in. Deferred tax impact is coming in. So here, student, anyway, they have mentioned about the at the time of selling property capital gain tax of 28%. That is a deferred tax impact. You have to adjust that as well. Even though the 5 million gains come, there's a deferred tax liability arising just because of that. For this 5 million, you have to set aside the deferred tax liability. So I am going through these fast because students, those things are already tested in the examination. Past examination, if you do past paper question, you may come in with similar kind of adjustments. So it's very straightforward. So what is the fair value of net asset? Is 143,600,000. Then fair value of not the fair value, NCI is measured at proportionate share basis 20%. It means out of this 20% NCI, right? So what you do is you are coming here and you are going to fill up the goodwill computation plus NCI, purchase consideration plus NCI, and make sure you put the NCI balance to NCI RL column as well. RL column as well. And fair value of net asset, very straightforward, student. This is given to us. We have computed here, we have computed here. And goodwill, you can compute, it is 8,125.25. Right, done. First part is over. From the chicken, first part we have actually all completed. So no need to worry, no need to worry. First part is done. First part is done. Goodwill on RL done. Now you can get, let's say, out of this 22, how many marks allocated? 22 marks. Let's say 7 marks, 6 to 7 marks you have taken. Right. We'll go to the next one now. So we are going to have the MPL. So NPL is student. So here I have showed the MPL. So cash consideration is 27.5 million. You paid cash in terms of 27.5 million. You go to the question paper and see the net assets. It is 60 million at the date of acquisition. 60 million at the date of acquisition. Here, student, keep one thing in your mind. Lot of students don't know if it is an investment in joint venture and investment in associate, what is the standard relating to that particular adjustments? What is the standard? Can someone tell me the standard? The name of LKS 28, right? Sorry, student. Basically, LKS 28 talks about basically investment in associate and investment in joint venture. So what is happening basically, student? When it's come to LKS 28, it is required you to do goodwill assessment, not a goodwill computation. You might be quite surprised. When it's come to investment in associate also, you need to do a goodwill assessment. You don't believe, student, investment in associate, that equity accounting also some kind of a simplified version of consolidation, right? If I had the time, I will prove it, but I can't do it in now. No, student, in this equity accounting also, you have to have some kind of a goodwill assessment. How you are going to do goodwill assessment? Let's say fair value of net asset. What is the amount? 60 million. Out of this 60 million, you are going to purchase how much? 55%. 55%. You are going to purchase 55%. It means 33 million worth of assets you are going to purchase. But what is the purchase consideration you are paying? What is the purchase consideration you are paying? You are paying only 27.5. It means you need to have a bargain purchase. This is a bargain purchase. Bargain purchase, right? 33 million worth of asset you have acquired by paying 27.5. You need to have a bargain purchase adjustment of 5.5 million. If this goes other way around, let's say you pay 27.5 and whatever the fair value of net asset acquired is 20 million, then it is not required, because already whatever the initial investment, initial cost of the investment include the goodwill. But here, this bargain purchase you have to separately deal with. So this is, student. So I am going to deal with investment in NPL. Purchase consideration. What is the purchase consideration? You can see here 27.5. 27.5. And now we have the bargain purchase. You have to debit it to the investment and you have to credit it to the group. Sorry, you have to debit it to investment. You have to credit it to the group return earning. To denote the crediting, anyway, group return earning, you have to show the plus balance. Bargain purchase. So that is required to be done. This is not that much common adjustment to student, but this adjustment is there. If I'm not mistaken, last time one of the past papers or this was tested. Most of the students have not answered very well. So this you have to keep remember, right? Okay, student, now that is also done. Now 7 marks done. For this NPL thing, let's say 3 marks done. Out of 22 marks, 10 marks you have scored. So even you don't answer, let's say, don't pressurize when it's come to the consolidation question, student. I don't have time. I don't know the entire question. I don't, what is happening most of the time, if you have a single, let's say you don't know disposal, but don't afraid, even though you don't know disposal, this question already, I haven't touched a single thing on disposal, but at the moment I have gained 10 marks. I have gained 10 marks. That is the beauty of consolidation questions. So don't think about, if you don't know something, forget about it. Leave it and do others well. Don't get confused. Don't get afraid. That is my golden advice that I can give you, students. So don't get afraid. That is required from you, right? So student, it is done. It is done. Now what we have to do as per here. So there is a date of disposal. There is a date of disposal. Then what you have to do? You have the date of acquisition. You have the date of disposal. Till the date of disposal come. Till the date of disposal come. What you are required to do? What you are required to do? You have to. What you are required to do? You have to. Sorry. Right. Till the date of disposal, you have to identify the post-acquisition reserves, right? You are absolutely right, Nikma. You have to identify the post-acquisition reserves and you have to adjust those things, So here, student, if you go to the question paper, you can see this point to this point, acquisition date to the disposal date. What is the post-acquisition reserve? 140 to 170. 140, 170, 30. It's 30, right? So in terms of the return earning, 20 million increase. In terms of the revaluation reserve, 10 million increase, 30 million increase. So that post-acquisition reserve, you have to treat first. So come here, we will treat the post-acquisition reserve till 31st December 2021. RAL, retained earnings 20 million, revaluation reserve 10 million. So how to do it? How to do it? Out of this 20 million, 80% belongs to group retained earning, and the remaining 4 million, let's say we can find the remaining 4 million, or let's say remaining 20% belongs to RAL, retained non-controlling interest. Non-controlling is you divide 80%, 20%. So revaluation reserve also you should have some kind of a division. So here it's 10 million. So you can do it 10 million into 8%. Here NCI is having a part 10 million into 2%. That is completed. That is completed. Now that is done. Now we'll come to MAL, because MAL also having some kind of a post-acquisition reserve. It should be accounted under equity accounting as per SLA LKS 28. So you need to mention it. It's a decision point. So you can say this should be accounted under equity accounting. That is enough. That is enough. No need to write then define the equity accounting. Equity accounting, we do this. That is not enough. It is visible in the computation. So at least you have to tell. It is a decision point. Since it is a decision point, you have to tell in the examination. So right here, what is happening is student 60 to 80. It's having 20 million. Basically, 20 million comes retained earning 10 and revaluation reserve 10. So that thing you need to adjust. That thing you need to adjust. So retained earning 10. So what is happening is student investment in NPL, retained earning 10%. How you do it? 10 million into retained earning 10 million into 55% to investment in NPL. So this is the investment in NPL. I am using equity accounting, initial investment first, whatever the profit earns, and it goes to group retained earning as well. If I put a double entry, investment in NTL debit, joint venture debit, and group return earning credit. So a revaluation reserve also you need to have similar kind of an adjustment, and it goes to group revaluation reserve, right? Anyway, these things are not important. Only these first four columns are important, but for the understanding purpose, I am preparing the last two columns, right? Okay, so what is happening, student? Then basically we'll complete that as well. And now we'll go to the proposal one. What is the proposal one? Sell 70% of RA. You are going to sell the 70% of RA. So student, basically, so when you are selling the RA 70%, it is selling for 120 million, and the remaining interest 10% fair value is 20 million. So what you do is, if it is a disposal, you have to follow this. You have to follow this particular schedule. Keep this in your mind. Disposal proceed. What you are going to do is, first you are going to sell the disposal proceed, which is 125 million. So you compute. What I am going to do is, I am going to compute the disposal gain and loss separately using a schedule, and I am going to incorporate that figures into our main working. So disposal proceed 125 million. This is the proceed you received in terms of cash. Since you are keeping some interest, remaining interest, 10% interest, that interest need to be measured and fair value, and that also should be considered under here. So what is the fair value? It is, if I am not mistaken, it is just 20 million. Right, 20 million. Then less interest in subsidy. So what is happening? This is basically how you compute the disposal gain or loss. Forget about the consolidation. How you compute the disposal gain or loss, student? Selling price into whatever the carrying amount. Let's say PPE, carrying amount, and selling price. The difference between that, you get the disposal gain or loss. Similar thing applicable to here. Here selling price, but we are not selling everything. The sum part consider as the fair value of retained interest. But other part, this is the carrying amount. So how you are going to remove the carrying amount? So net asset at the disposal date. So you have to take the net asset at the disposal date. So that is the carrying amount of asset base. What is the net asset at the disposal date? It is 170 million given in the question. So you don't need to worry. So I will show it here. Right, 170 million. Then what is happening? Goodwill at the disposal date. So you have to add the goodwill. So what is the goodwill, student? Goodwill, it is here. You have to add that as well, because no point of keeping a goodwill in a situation where you lost the control. Can you keep the goodwill where you lost the control? 80% subsidy, 70% sold, you lost the control, you can't keep the goodwill in the book. So you have to remove the goodwill also from the books. Right? Carrying amount of the NCI at the disposal date. That you need to follow. That you need to find out. Carrying amount of the NCI, how to find? Here we have, right? So we have initial NCI and the subsequent return and post acquisition return earnings, post acquisition revaluation reserves, with all those things. So you can find it is it is 34,700,000 something. So what you do is, you put that carrying amount of net asset here, carrying amount of net asset minus, right? So there are some, right? So don't we need to adjust carrying amount of fair value adjustment into 5 million? No, carrying amount of fair value 5 million. It is included in here, no? I have taken it to the fair value of net asset here. Nekmal, I have taken it to the fair value of net asset. So it is included in here. So not required to adjust it separately, right? Okay, students. So here, now, so I am going these things by somewhat fast. So you can take the total balance. It is 143 million. Then what is happening? 145 Here we have the total consideration and 143. You plus this minus, you get the 1.59. This is the loss of disposal. This is the loss of disposal. Loss of disposal, right? This is a disposal loss. Okay, this is a disposal loss, right? Here, student, now how to record the disposal loss in the financial statement? How to record the disposal loss in the financial statement? Here, what you need to do, something like this. Here, I am going to put the disposal entry. So you have to remove this NCI component. You have to remove this NCI component. Done. So NCI, after that, NCI is becoming 0. No NCI after that. NCI is becoming 0. Right. And this goodwill also, you have to remove. This goodwill also, you have to remove. After that, there is no goodwill. There is no goodwill. Goodwill also need to remove. Then what is happening? Disposal gain, no loss. Since we have a disposal gain here, you have to incorporate it in the gain here, you have to incorporate it in the group retained earning balance. That is the only requirement. That is the only requirement done. Then what we have next, third part also completed. We have the NPL. NPL, we'll go and look at the NPL treatment. So proposal 2, basically what is happening? Proposal 2, you are going to acquire another 25% of NPL. You are going to pay 25 million in cash, and whatever the remaining 55% is fair value is 35 million. So we have to consider two things. So what you have to do is you are paying when it's come to NPL. Since I can't visible this, I will take this to here. Right. So here, student, you can see now cash you are paying 25 million. Cash you are paying 25 million. Previous holding. So what is the previous holding? If you compute the total holding here, as per the equity accounting, the balance we have 44 million. So that 44 million goes out. An investment in associate now 0, it becoming 0 after this adjustment. But you have to consider the fair value of this earlier holding. What is the fair value of this earlier holding? It is 55 million. It is 35 million. It is 35 million. What is happening, student? You have to take 35 million here. What is happening, student? 44 million equity accounted balance goes out, but you are taking 35 million into the goodwill computation. You have 9 million loss, and that loss should be reflected in the group retained earning. That's what should be reflected in the group retained earning. Done. And what you have, then you have to measure the NCI as well. How to measure the NCI? As of the date of acquisition, you have to get the fair value of net asset. What is the fair value of net asset? It is 80 million. Fair value of net asset 80 million. So you come here, you record the fair value of net asset 80 million. And out of this, what is the NCI percentage? What is the NCI percentage? Proportionate share basis. After you acquiring 80%, NCI remains 20%. NCI remains 20%. You have to take that as well and put the NCI figure to NCI column, and you can compute the goodwill. You can compute the goodwill. You have gain on bargaining purchase, not a goodwill, gain on bargaining purchase. When you have a gain on bargain purchase, you have to immediately transfer it to where? You have to transfer it to group retained earning. You have to transfer it to group retained earning. That is also done. That is also done. Then what is remaining at the moment? The remaining thing is, student, now we have acquired the joint venture becoming the subsidiary. Now we have the post-acquisition reserve of 5 million, and that you can adjust here. Post-acquisition reserve of 5 million. How to adjust it? How to adjust is out of this 5 million, 80% to the parent as well as 20% to the NCI. So if you want, you can get the total and see anyway goodwill. So you can take the NCI total. But group return earning, don't go and compute. Why? It is not required. You don't go and compute why it is not required. And since the parent return earning also not there, it is not required. That is done. That is done. You got the 22 marks. You got the 22 marks. It's easy. So, but we have another part of the question student. So this is also very much important. COVID-19. So basically, student, we have noted in recent past papers, there's a question from COVID-19 because student, COVID-19 is one of the century pandemic we call normally. So since because it's a one of the century pandemic, we don't have an accounting standard for COVID-19. Since we don't have accounting standard for COVID-19, there are a lot of financial report and repercussions are arising from COVID-19. So basically, if I'm not mistaken, not actually in 2021 July paper, they have asked from the COVID-19 impact from audit committee. Then September paper, they have asked it for, right, September paper they haven't asked, but they are continuously asking some question from COVID-19 pandemic. And that's why this paper also there's a COVID-19 question. So we will read that as well. Outline 2 challenges faced by Bill Green Limited due to COVID-19 faced by, right. So I have seen, when I see the transcript, some students are writing import restriction, oil price increase, balance of payment crisis. So those are not, those also impact from COVID-19, but what they asking is student, they asking when it's come to discharging their fundamental responsibilities toward financial reporting. So you have to write not the economic impacts, business impact, what are the impacts for financial reporting? And this question is limiting to proposal 2 as well. Proposal 2 as well. So proposal 2 is what? It is about further acquisition of that joint venture. That is the proposal 2 is about. So what is happening, student, basically, when it's come to COVID-19 pandemic, there are a lot of areas which was affected. Basically, student, financial reporting process affected, audit committee was affected. So what is, just to give some kind of introduction, when it's come to financial process, fair valuation. Because fair valuation, as per SLFRS 13, it is said fair value is the price paid in orderly transaction in a orderly transaction in a no orderly transaction. The orderly transaction word is there. Orderly transaction means normal transaction in a normal market. But when it's come to COVID-19, what has happened, student? COVID-19 has created distressed transactions. So fair value, it should be orderly price. But what has happened? Let's say the share market, the transaction volumes are jumbled and it is distressed price. So fair valuation was the biggest threat. The biggest threat came for the fair valuation just because of COVID-19. Whatever the prices in the market, you can't say it is the fair value. So anyway, Institute has issued separate guidelines in 2021 March, April for COVID-19 as well. If you have time, just for you understanding, you can go through those things as well. Another thing is, when it's come to COVID-19, there's a lot of impact came for expected credit loss computation, expected credit loss, because future uncertainties are there. We don't know how the economy is behaving. Likewise, expected credit loss also impacted. Other than that, student, let's say the borrowing cost, some projects ceased for 2 to 3 months period just because of the lockdown. In that period, can we capitalize the borrowing cost? That is a problem. So borrowing cost and deferred tax asset, because there are some companies, deferred tax asset can be claimed only where you have the taxable profit in future. Just because of the COVID-19 pandemic, some companies completely collapsed, and there is a question whether that company earn profit in future. In that case, can we keep the deferred tax asset? Recoverability of the deferred tax asset was a problem. Likewise, there are a lot of implications from the financial reporting. Audit committee basically responsible for risk management of the company, basically responsible for ensuring the financial reporting process are true and fair. Whatever the significant decision, judgments taken by management, audit committee to review. So what has happened? Risk management, internal control system. Let's say you are working in work from home environment. Is your company having some controls in work from home environment? No, the control environment of companies were challenged. The audit committee has to look over that. Then other than that, whatever the management are taking significant judgments, especially when it's come to fair valuation, those things also need to be reviewed by the audit committee. There are a lot of repercussions came, student. So here, this particular example, student asking from to proposal number 2 regarding financial reporting. So proposal number 2, what is there, student? When it's come to acquisition, where we need to determine the fair value. Here they have determined the fair value of 55% holding is 35 million. Likewise, they have determined the fair value. But this is happened during the period of pandemic, students. So what you can say, this fair valuation computation happened during the period of pandemic. So this, we don't know whether this price is a distressed price or is this price is actually reflecting the market price. That was the problem. That was the problem, right? That was the problem. And other thing is, yes, some students are saying disclosure. Obviously, student, I have not mentioned that as well. With the COVID-19, we got a lot of disclosure requirement. The best disclosure requirement is the hectic one is the going concern disclosure. So every company is required to publish a going concern, separate going concern assessment and going concern disclosure. When it's come to risk management disclosure, credit risk, exchange rate risk, whatever the risk, we did that. We have to prepare. Institute has provided guideline, if I'm not mistaken, April 25th in 2020, Institute has provided the complete guideline for the disclosures for COVID-19. Based on that guideline, we have given corporate going concern disclosures. So a lot of disclosures were required just because of COVID-19. Anyway, student, so this particular example, since just because of proposal 2, the first one I can say, the first one is the fair valuation, fair value determination. The next problem you can say, recoverability of this. So you are getting some net assets to your company, and for the goodwill computation, you are getting some net asset. But the problem is, let's say we don't know, it is not given in the standard what are included in the fair value of net asset. But let's say there are some assets and we need to assess whether whatever the assets we are acquiring from that subsidiary is recoverable. That also one of the challenge faced by just because of the COVID-19 factor. Another thing is the discounting factor. Discounting factor with COVID-19, what has happened in Sri Lanka, we have gradually came to low rate market condition. It was like 10%, 12% before the COVID-19, and suddenly it came to 8%, 7%. So what should be the, here this example, they have used 10% discounting factor. So when there's a discounting factor, present valuation requirement, that also need to be considered. I think that is enough for the understanding. That is enough for the understanding. And student, if you have any question, it is the time now. You can ask any question. It is almost close to 11. And thanks for trusting the institute, and thanks for supporting this course. And my special thanks should goes to institute, because this is the first time they are doing this kind of a thing, and I believe you got a maximum out of this. And I personally wish you all the very best for the exam. When it comes to the exam, keep all the guidelines that I have provided to you. Keep remember, don't panic, don't get panic, stay focused and write the answers. Especially when it comes to consolidation question, don't go and try to eat the entire chicken at once. Part by part, you have to eat the chicken. That is very much important. Part by part. Keep remember. So when you are going to the examination, you should remember that, right? You should remember that. Otherwise, you can't do it. Student, so can we have a webinar for pre-scene analysis soon? I don't know, because you have to ask it from the CS Sri Lanka. Anyway, I think education division has done a tremendous job. Lakmali, the director education, and Lakmini, Aruna, and Augusta, every person has done a good job. And thank you very much on behalf of the students. On behalf of the student, I am saying thank you for the institute. And I hope, do you have any questions, student? You can ask now. I am ending the session. So I will wait here in the platform within a few minutes. So I think institute side, do you want to make any announcement? Do we have anyone from the institute side? So should we take the disposal gain of financial assets, which was subsequently measured fair? Yes, we have to get. So this is not a question related to this particular subject. So Ravin, basically, when it comes to disposal gain, whether it's fair value through OCI, fair value through P&L, it goes to P&L, disposal gain. But keep remember, when it comes to equity instruments, classified under fair value through OCI, you can remember irrevocable election. So whatever the fair value gains, not the disposal gain. Whatever the fair value gains, so there's a super thing, disposal gain and the fair value gain. Whatever the fair value gain you have already identified, it should not goes to P&L. So you can't reclassify to P&L. What is happening? Fair value through OCI equity instrument. Fair value through OCI equity instrument, the fair value gain you have recognized in OCI, you can't transfer it to P&L. The only thing you can do is you can transfer it to retained earning, and that is also optional. Standard is saying you may transfer it to retained earning. It's a retained earning adjustment, just equity statement transfer, nothing else. So other than that, even for the debt instrument classified under fair value through OCI, that can be reclassified to P&L. That is the only requirement. That is why I'm telling fair value through OCI in equity instrument is some kind of a derecognized option given by the standard. It is not encouraged, not encouraged option given by the standard. So standard want you to show whatever the shares in the FVTPA. So that's why irrevocable option is given. Since the fair value gains, you can't take into P&L. Right? Any more questions, student? So should we calculate gain or loss when the investment in JV is transferred to sub-investment? Investment in JV. Should we calculate the gain or loss when in the investment in JV transfer? Yes, yes. So basically, student, in that particular example also, we had a carrying amount of the joint venture 44 million. But when we do fair valuation, what has happened? It is only 35 million. Then whatever the difference, you have to take into your gain or loss. Consider as a gain or loss. That can be done. That actually it is also fair value gain or loss. So that is we have done. We have transferred it to group retained. Okay, student. So I think, sir, when we answer, should we show the answer in one computation schedule like you did, or can we show calculation separate each path? As far as you are showing in a clear way, that is fine, student. That is fine. I am using schedule method because I feel it is very easy. And one more hint I can give you, student. So CA is having some other programs. I think you know they have a dual membership scheme with ICAW, and immediately after CA you will be doing some other professional examination as well. In that case, those examinations more encourage option is the schedule method. So that is why I personally, because I am a member of ACC, I'm a fellow member of ACC as well, not only chartered accountant. So I know when I'm doing ACC, I had to use the schedule method, right? So can we do the T accounts? Of course, chartered, you can do the T accounts. Anyway, there's no major difference, student. So I am preparing goodwill column. T account is cost of control, similar thing. So goodwill column equal to cost of control. This time physical exam, obviously yes, but those who are in foreign country, they have the online option. This time physical examination, and it is so last few times we have got some complaints from the student. Personally, I got just because of the virtual setup. There are some problems when you do virtual setup. So this is the best time, student. You have the physical examination, get the maximum out of it. Right. So any other questions? Any other questions? Thank you very much then. Thank you very much. I have taken a lot of time, but ultimately the education division also communicated to me, this is not just a paper discussion, this is a guidance session that I have taken this much of time. If it is a paper, this may be ended up with 2 to 3 hours, right? Can you share the Excel sheet? I think Institute will share you a suggested solution, right? Thank you so much. Thank you so much. So I have, if it's the physical, how to do console, T method, so your method. So do it in your method, student. Now, if you have followed some kind of a method, let's say now you are familiar with the T account, don't go and change the method. You go ahead with the T account. This is not a time to change. Okay, student, this is not a time to change. Another 20 days, you focus on whatever the method that you have. Don't think about the method. My method also accepted. T account also accepted. So you go ahead with your method and do it. Don't worry. As far as the answer is clear, you can score marks. That is okay. Okay, thank you very much. Thank you very much. Then I am ending the session.